Fed has not laid out a strategy in a way that's clear. That leaves the markets to overlay their own interpretation.
Everywhere I look, that sense of optimism and the soft landing story, that's definitely what is being priced in.
I think we're priced in Fed rate cuts and rescuing the economy. I think the jury's still out on that.
There really are risks on both sides of the Fed's mandate.
There's data out there. If you put it all together, I think you can create a pretty clean picture for yourself.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just about unchanged on a 5-day winning streak on the S&P, extending the longest winning streak of the year so far. Look out below for one stock in particular. It's Tesla. The outlook, Bramo. What outlook for Tesla in 2024?
It looks dreadful. The idea that they were selling cars for lower prices last year, at the end of last year, than a year earlier, tells you everything that you need to know. The fact that Elon Musk talks about not really running a car company, but owning a tech company, also tells you everything that you need to know. It's not very fun to own a car company. It's very fun to own a big tech company. The
stock is down by about 8% in the pre-market. Analysts sounding dazed and confused going into the earnings call and coming out the other side. RBC saying the outlook was vague. AMH Morgan Stanley's Adam Jonas saying for 2024, investors and analysts are very much on their own, in the dark at the moment.
Well, also the big concern is we have an EV glut right now. So if Elon Musk is not cutting in 2024, where is there going to be demand for some of these EVs? Because he had to bring down the prices in order to maintain this competitiveness. And now if there's an EV glut and the prices aren't getting cut, why would you go out and buy a Tesla?
If I were a shareholder and the CEO of a company came out and said, I'm not looking for additional economics, I just want to be an effective steward of a very powerful technology, would you feel comforted? Would that be a comfortable feeling? I don't care what your returns are. I care about some highfalutin concept of technology. That's where we're at.
Who are they in competition with? Domestically here in the United States or China?
China. Yeah.
This is the issue, I think, right now. Do you want to buy a manufacturer that is in a race to bring down prices against a Chinese maker of EVs? That, for me, sounds pretty difficult.
Which is the reason why it was notable that Elon Musk, on the earnings call, praised Chinese car makers. He basically said, if there are not trade barriers established, they will pretty much demolish most of the car companies in the world, perhaps including Tesla.
He's using the same language that BYD's founder also used last year. He said we were going to demolish the old legends. Everyone in the commodity space has been talking about this. China's going to lead because they have access to the raw materials that build those batteries. At some point, China can say, we're no longer exporting these commodities, buy the car.
Not just that, cheaper labour. Hello, UAW. UAW comes to a big agreement with the big manufacturers here in America, Ford, GM, Stellantis, and all of a sudden, you get this bidding war for talent in America, and Tesla has to start thinking about offering higher wages as well. And for me, Bramo, that complicates the effort even more. To compete with the Chinese manufacturers at the time that this is happening in this industry in America, it gets even harder for Elon Musk and Tesla.
Which is the reason why you see those stocks in free fall. This one Morningstar analyst, Seth Goldstein, came out and said that Tesla is signaling the days of 50 or even 30 to 40% growth year over year are over. The question is there growth at a time where there's not yet enough automation to overcome some of that higher labor cost that you're talking about?
Dan Ives of Wedbush is coming up on the programme in about 10 minutes' time. Don't miss that conversation. I want to sit on the ECB just for a moment. Federal Reserve decision about a week away. European Central Bank news conference later on this morning. The to-do list for ECB President Christine Lagarde in today's news conference. Never mind the economy, never mind inflation, never mind interest rates. Let's talk about mutiny inside the central bank and also the political questions that will be asked in this news conference after the political statements of the leader herself.
It's a related question, right? How much does Christine Lagarde address the fact that she badmouthed Donald Trump, essentially, and talked about the need for the European Union to respond to that, while also shoring up some confidence internally with people having dissent? Also, how much did she push back against the Davos news conferences that she held, where she basically was saying that she's expecting a summer rate cut and didn't seem to push back on the market?
Exactly. She told Francine Lacroix, summer is going to be likely. So what is is the point of today's news conference? You're talking about the path of potential rate cuts in Europe and what she might say about the U.S. president. She said it all. I don't think there was anything left for her to say, to leave on the table. She did so in Davos. So I'm not really sure what this news conference is actually going to be about.
Christine Lagarde, Volume 3, a little bit later on this morning. Let's get you to price action on equities on the S&P 500. 5-day winning streak on the S&P. Equities totally unchanged this morning. Yields are lower by a couple of basis points. 4.1587 on a 10-year. Lisa, you want to talk auctions?
Yeah.
Sloppy one yesterday.
Yeah, 5-year auction that really, in the parlance, tailed. Basically, it came in, it sold at a higher yield than it was trading before the auction happened. Auctions matter because not only was this a sloppy auction, but it determined the sort of risk-off feel, not in big tech, because nothing can harm big tech, apparently, but in the rest of the complex of equities. And to me, that tells you, today, 1 p.m., 7-year auction, be there.
I'm looking for TK to walk through the studio
I know,
door
exactly.
and correct
like,
you any moment
stop
from now.
it. Yeah, exactly.
He's not coming to correct this anytime soon. Coming up on the programme this hour, Citi's David Bailyn on the US equity market rally, Dan Ives of Wedbush on Tesla's disappointing quarter, and Brooks Sutherland of Bloomberg Opinion on the latest blow to Boeing. Boeing in the pre-market down by 2.7%. We begin with our top story. The US equity rally continues. David Bailyn, CIO of Citi Global Wealth, sounding optimistic in his latest outlook, writing, quote, "We expect rolling recessions to end in 2024 as earning growth accelerates. Labour markets have outperformed, but corporate profits are set to recover." David Bailyn with us around the table. Morning, David.
Good morning.
Where are you looking for that recovery for corporate profits? Sector-specific or right across the index?
Well, both in the sense right now. So we very much are of the opinion that all of the S&P sectors will become profitable in 2024, whereas about half of them were in 2023. And what we see happening is sort of a somewhat contradictory. On the one hand, you're going to have labor growth slowing and productivity rising. Also, if you take a look at the market last year, most of the companies were winding down their inventory. So now they're building up inventory. And that is going to allow, that collectively will allow profits to rise. And we're beginning to see in the first quarter, right, the data that's being reported now in last year, that profits actually are on the rebound. We see that starting in the third quarter of last year and extending all the way through 2024.
So tech has dominated over much of the last 12 months.
Absolutely.
Beginning to lean into the cyclical parts of the market a little bit more?
Yeah, absolutely. I think there's value in healthcare, there's value in consumer cyclicals, and there's going to be value in industrials. But the big story is the difference in value between large cap, especially large cap tech, and small and medium-sized growth companies. You can now buy, small and medium-sized growth companies at 15.5 times earnings at a time when their earnings are going to accelerate, in part because of AI and in part because we're coming out of a relatively difficult 3-year period. It's a good time.
Well, does it concern you how sensitive some of these smaller stocks have been to bond yields? I mean, we get a bad auction, all of a sudden they're negative on the day.
Well, this is what's creating, I think, the buying opportunity. We have an enormous amount of cash sitting on the sidelines. Investors are simply not putting a lot of money to work yet. And yet, you don't want to pick your perfect market time because there isn't one. When I think about the interest rate sensitivity, you are right now, in my view, like at almost 420 on the 10-year, with the auctions being what they were yesterday and probably today. You're sort of, again, near these peak rates at the moment, right? You're sort of at that point now because people still worry about inflation. And there's just not a lot of data to support the idea that there is any. So I think that we're at a point now when we're expecting the broader market to really do well, and that's just ahead of us. So it's a good time for portfolios.
I was speaking with Joe Davis yesterday of Vanguard, and he was talking about the same thing. If you really believe in AI, why wouldn't you buy all the other stocks and all the other industries that are going to benefit from some of these technological advancements in a more significant way? That said, aren't the big tech names kind of priced to perfection at this point, given that they've been the sole place that people have hit out?
So think about it. They had down earnings in 23, down earnings of 22 of almost 25%. Then the big tech earnings were up 40-odd% next year. And your next guest will talk about it. And this year, they're going to be up 25% more. So they're priced fully. But what's not priced fully is the impact, right, of AI on the value of these stocks, their ability to grow faster, and the increased productivity of the people who use their software. All of that is yet to come. It'll affect places like Citi as well. Just the banking sector alone will become more productive because of these tools. And I think that's simply not priced into the market. And that's really not what I'm basing our base rate on. I think that's like a plus for everything. Let's
get you some earnings from Alaska Air. Lisa, let's go through these numbers together. So they've put a price on the grounding of the 737-9 MAX a $150 million negative impact from that grounding. Lisa, new outlook, 2024 adjusted EPS $3 to $5. The estimate was $5. So that range, the lower end of the range, much below the estimate this morning.
Yeah, even though they came in the fourth quarter above estimates with earnings per share of 30 cents versus 18 cents. Shares not moving that much. The fact that they've got to quantify what the grounding of the Boeing 737-9 really has done to them highlights the ongoing discussion that we've heard from the executive branch. Loose screws. We don't know what the path is to bring them on. And hey, guess what? The 737 MAX 9 no longer being manufactured for the time being, with the FAA still kind of investigating.
All inspections will be completed by February 2nd. The outlook from Alaska Air, according to Alaska this morning, includes the gradual return of the 737-9 MAX fleet through early February. We're going to get a lot of airlines this morning, aren't we? That's the first one out of the gate.
We're going to be getting Southwest as well, not as affected or as infected at all by this, but definitely the sort of lower priced airlines. There's this question around deals and what the deal environment is going to be. And I say that because there was this concern about some kind of merger within the airline space, JetBlue, and what that's going to do going forward. That was stymied by the courts. How much is the deal environment going to be affected by the political backdrop and the fact that certain deals that might make sense to the airlines are not really coming through the court system?
Paul Taubman is going to catch up with us a little bit later this morning in the next hour. David, could we talk about the prospect of consolidation and maybe introduce the political theme as well? Are we going to put some deals on ice until we get some clarity of what Washington, D.C. looks like in the next 12 months?
I actually think this is going to be an interesting deal year with an acceleration of deals due to the just the latency of what's gone on. You've had such quiet markets for a long time. So I think there are going to be some deals that are going to be easy and that are going to require very little regulatory scrutiny, very much unlike the JetBlue Spirit transaction, right, which got put on ice. So, but in general, you're seeing it. We've seen 8 biotech transactions of size, right, this year already. And we're seeing a bunch of IPOs being planned, out of private equity portfolios for later in the year. So I think there's going to be a general pickup, regardless of what happens in D.C.
I was reading a Savita Subramanian note of Bank of America, and she was talking about how this is a time for idiosyncratic risk more than almost any other. How do you plan for that? Are there industries, are there places that you're looking for that idiosyncratic risk in a new way?
Yeah, so what's become, sort of an obsession on the people who are doing the stock picking is looking at the ability for managements to actually execute their business plan in this environment, be able to embed AI, increase margins, watch their expenses, and be able to convince you that they can execute, right? And so that's becoming a huge differential in how equities are being priced. And I think that's also ahead of us. So it's a time when you talk about idiosyncratic risk, but you also talk about the benefits, right, of real ability to execute strategy.
David, you're going to stick with us. It's going to catch you up. David Bandin there of Citi, just to get you up to speed on some of the price action. Equity futures on the S&P, just a touch positive in the pre-market. Tesla down and down hard through most of this morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Boeing is facing more setbacks as the FAA freezes production of the 737 MAX. Regulators say they won't agree to any request for production expansion until quality control issues are resolved. The move is expected to impact Boeing's bottom line. CEO David Calhoun is relying on the 737 MAX line as a cash cow. Calhoun told U.S. senators yesterday the safety issues can be resolved in a, quote, matter of days and weeks, not months. Tesla under pressure after reporting slowing sales growth, and CEO Elon Musk's pitch to investors doesn't seem to be working. Musk suggests that the disappointing results are temporary, prompting plans to manufacture Tesla's next-gen vehicle at its Austin and Mexico plants starting next year. But investors are skeptical, noting Tesla's handful of price decreases last year ate into profits rather than boosting sales. Fast food chain In-N-Out is closing its first location in the 75-year history. The company will close its only restaurant in Oakland, California in March after a wave of car break-ins, theft, and robberies. Chief Operating Officer Danny Warnick says that although the company has taken repeated steps to create safer conditions, customer and associates are regularly victimized. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. 2 points in the last story. 1, best fast food on the planet. No debate, no discussion. Best fast food on the planet. 2, how sad is that?
That is sad, but you realize it's the best food because you're eating it in your car. like the way they deliver it.
No, I go inside. Also,
you eat In-N-Out inside?
Yeah, and Janet Yellen, I think, would agree with you because remember at APEC, she stopped there before going to greet Chinese officials.
Ever eaten In-N-Out?
Yeah,
Okay.
LAX,
All
just
right.
around the corner from the airport. First port of call, wherever I get to California.
That's it. And it's
Straight around the corner.
And
You're the only
last port
person I
of
know who's
call.
ever gotten into
Every
the store,
single
by the way.
time. I'm very polite to the Uber driver. I ask for a favour, and he gets a good
Stop
tip.
by.
Can we just stop by In-N-Out? Every single time.
Never knew that about you.
Up next on the programme, Tesla leaving analysts in the dark.
That will be a challenging production ramp, but I am confident that once it is going, it will be head and shoulders above any other manufacturing technology that exists anywhere in the world.
That's coming up next on the programme, live from New York City this morning. Good morning. You're watching Bloomberg Surveillance. From New York City, equities just about unchanged here on the S&P 500. Bond yields lower by 2 basis points, 415.68. Under surveillance, Tesla leaving analysts in the dark.
Tesla is currently between two major growth waves. We're focused on making sure that our next growth wave, driven by next-gen vehicle, energy storage, full self-driving, and other projects, is executed as well as possible. That will be a challenging production ramp, but I am confident that once it is going, it will be head and shoulders above any other manufacturing technology that exists anywhere in the world.
Here's the latest this morning. Tesla missing estimates, warning of, quote, notably lower growth, choosing not to offer full-year targets. A rare move by the EV maker. Dan Ives, senior equity analyst at Wedbush, writing, quote, we were dead wrong, expecting Musk and team to step up like adults in the room and give a strategic and financial overview. Instead, we got a high-level Tesla long-term view with another train wreck of a conference call. Dan Ives, not holding back. He joins us around the table. Dan, good morning to you.
No, great to be
You
here.
sound disappointed.
Look, I mean, this was an important call where Musk and the rest of the team needed to step up, adults in the room, give some guidance in terms of what's happening on pricing, the margin pressure strategically. And I'd say train wreck would probably be soft because this was one where the long-term story is intact, but in the near term, they needed to navigate, communicate. They didn't do that. You'll see a lot of pressure on the stock.
A dreadful assessment. Stock is lower by something like 7% in the pre-market. Have you changed your call on the name?
Look, I mean, we're still bullish, but from a fair value perspective, I mean, 350 goes toward probably lower threes, 3 to 315 from a base perspective because numbers are going to come down. And the biggest issue here is that you didn't give goalposts. Because by not giving goalposts now, the bears are going to run with it. And look, the Bears won last night. The long-term story is intact in terms of FSD, in terms of if you're a believer in EV, which we are, $1 trillion market cap, I do believe is on the horizon the next few years. But in the near term, I mean, this is one where it's a glass half empty relative to how they talked about it. I mean, this was sort of a 101, not how to do a conference call.
I want to understand what the threshold is for you to say sell. Because we have Elon Musk, who just said, as you said, a train wreck of a conference call, was not the adult in the room. He wants 25% of Tesla, or else he's going to walk and go develop some sort of robotics company. If he gets 25% of Tesla's shares, do you say sell?
Look, I think, first of all, I view that as sort of impossible here. There's not going to be a dual class situation from a share perspective. Plus, he did sell, he had 22% ownership before buying Twitter. So part of that in terms of the board will have some sort of comp package. Right now, it's caught in a legal issue in terms of Delaware. But I think if he gets more voting control, that's something that's going to ruffle feathers. But also the problem here is that the plane's crashing in the near term. And you're talking about salted or unsalted pretzels. And that's the biggest problem relative to what's happening in Tesla is that investors want to have some guidance. Give me some financial parameters, and you didn't get it. And look, and obviously we're huge firm believers, and that's the frustration.
Well, okay, as a firm believer then, what does it do to you that Elon Musk came out and basically said, I don't care if this company makes money. I mean, I'm paraphrasing, but he said, I'm not looking for additional economics, read more money. I just want to be an effective steward of very powerful technology. Does that bother you?
Look, I think in some ways the autonomous is going to be super powerful. And I think even what we saw with OpenAI and Altman, I mean, there's definitely a lot of unintended consequences here. I do believe in Dojo, Optimus. I could argue the value going forward from AI is much more than the EV and the actual value today of Tesla. But for Musk right now to kind of exert that, it's agita, it's Harper. It's the last thing as a bull you want to hear, and it does sort of put gasoline on the fire a little, and that's not what you wanted to hear last night. And it goes back to you need an adult in the room last night, and instead it felt more preschool type conference call.
Isn't this the cost, though, of doing business and investing in a company with someone like Elon Musk at the helm?
Yes and no. I mean, for investors like that, we've seen it for a decade, right? And you understand you take the good with the bad. But now, at this point, this was a huge period to sort of walk investors through, give some goalposts. Zach, CFO, with him gone, definitely feels a different type of conference call that we're seeing. And as long-term believers in the story, we remain that in terms on the other side. But in the near term, the bears won, and it's hard to defend. And that's why you're going to see pressure on the stock today, with 2024 being a trough year in terms of margins.
As a long-term believer of Tesla, Elon Musk also said last night that China will pretty much demolish most other car companies in the world. How are you looking at the space overall? He's basically setting Tesla up to be taken over.
Well, I think it's really Tesla and the Chinese EV players, because the price war that's happening, it's a Game of Thrones price war that's happening in Beijing. You're seeing it. I think that was the right strategic move in 2023. 2024, you can't continue to go down that path. At one point, you got to hold serve. And as much as we talk about FSD and everything else, for now, it's about, do you continue to cut prices? We thought 95% were done. We were dead wrong going into that conference call. That was a wrong call. Now it's defending, as a bull in terms of the long-term story.
I'm just listening to this, and David Bailyn, everything seems to be going on in the wrong direction. You've got costs going up, labour costs domestically in the United States for this industry. You've got prices going down because they're in a price war with Chinese manufacturers, and demand's not holding up. You see that time and time again. Another warning in the last week from the likes of Ford on what's happening in the EV space. How investable is this sector right now for you?
Yeah, I mean, it's really not an attractive sector because it's stuck in this sort of political G2 situation where you have, this overarching idea where, if you take a look at Chinese stock performance now, which is down, 5-year lows, 50% of what it was at that time, they're not about making profits, right? This is a market share war. And so you have a profit-making company against China in a situation where they have control over a lot of the inputs. It's a tough place to be.
So, David, this is a car company, not a tech company to you, right?
It's a car company now. I mean, I agree with Dan that over time, but when you're valuing it today, that's
a big question about the multiple then, Bramo. That's what it is now.
But that's exactly my point. And Dan, I would address this to you, that it seems like right now, anything with tech as sort of the highlight seems to be going far, far and away, and everything else is left behind. Doesn't that feel dissonant at a certain point if this technology is supposed to affect everything else? Doesn't it seem like this is too overpriced and this is too underpriced?
Well, look, I mean, the AI revolution, as we've talked about, the new tech bull market that started, we think tech stocks are up another 30% this year. For Tesla, the AI story will be there. But in the near term, you have to stop cutting prices, because then you give away margins, and then if Tom Ford starts selling sunglasses at $100 at CVS, can they sell for $1,500 on Madison Avenue? And that's the fundamental problem here that's happening with Tesla.
David, do you want to jump in?
No, I like that. I'm going to go buy
those. You're going to use that one as well?
I'm going down to the local corner drugstores.
I want to finish on
with me. We're buyers,
where Lisa went a little bit earlier in the conversation. I think this matters. Dan, I don't think you've articulated it well enough. I'm sorry. What would change your view on this name?
If we started to feel that demand was really falling off, not growing 20%, cutting more and more prices, giving that away, and you felt like it was more of a circus show rather than this more being a trough, bad communication period, that's where we'd have to seriously assess.
Okay. Dan, it's good to see you.
No, great.
Appreciate the catch-up. Just fantastic to get your reaction to that. Dan Ives there of Wedbush, together with David Bailyn of Citi. The stock, Tesla, down by something like 7%. Painted a pretty ugly picture, not just for Tesla. Let's be very clear about this. Tesla, people are still buying that vehicle. I'm talking about what's happening elsewhere in the industry. The likes of Ford, GM really struggling. If you think Tesla's struggling right now, think of the other manufacturers in this space trying to ramp up production and catch up.
And this is without the imports from China, right? And this, to me, is the key question. What happens if the Chinese manufacturers can sell their electric vehicles in the U.S. at much lower price points? The people who want the transition to a greener future might love that. Business, not so much.
Coming up on this programme, federal regulators ramping up pressure on Boeing. We'll catch up with Brooke Sutherland of Bloomberg Opinion in just a moment. That stock is down by something like 3% in early trading, and equities right now more broadly on the S&P 500 positive by 0.1%. Live from New York City this morning. Good morning. Live from New York City this morning. Good morning. Equities on the S&P 500 on a 5-day winning streak, looking to make it day 6. Equities positive by 0.07%. The Nasdaq just a touch negative. Tesla not helping here. We'll talk about that in just a moment. In the bond market, 2-year, 10-year, 30-year. Messy 5-year auction yesterday. Yields higher this morning, lower by 2 basis points on a 10-year 4.1568. Supply, Bramo, still matters.
Honestly, to me, this is what I'm watching. People say that it doesn't matter. Okay, auctions don't matter until they do. And yesterday did. And not only did you see a sell-off in the bond market, but you saw a sell-off in everything other than tech stocks. And that tells you that as much as people say we've moved on from the Fed, we've moved on from the rates market, there's still the tail wagging the dog.
TK reached out, sent me a message this morning and said he's got things to say about auctions. He's going to join us next week for the Fed special.
Fabulous.
Just to weigh in.
All right, we'll have
look out
lots
for that.
Fed special talk.
About a week away. In a market right now elsewhere in foreign exchange, the euro looks like this against the dollar. The euro just about positive, 108.89, positive by 0.04%. Under surveillance this morning, the latest ECB rate decision due out at 8:15 Eastern Time. Europe's central bank expected to keep rates on hold for a third consecutive meeting. Investors will be looking for clues of the first rate cut in President Lagarde's comments 30 minutes later. Many expect the ECB could be the first major central bank to cut rates since the global hiking cycle began. I'll say this, though. When you speak to people about the ECB, they're still penciling in the middle of the year. If you go on recent guidance from ECB officials, it doesn't scream March, it doesn't scream Q1, or maybe even Q2. It might be further out.
But right now, in April, the market is pricing in a 64% chance of an ECB rate cut. So here's the issue. How much is she going to push back, and will the market believe her? Because right now, it's essentially just her job to push back against a market that's already gotten ahead of itself with easing financial conditions. Where's the credibility, though? Because you've heard so many different kinds of indicators, and people are just ultimately looking at the data.
For Lagarde, she really has to stick to the summer, because she already said that. She put a line in the sand. She has this indication of intent for the summer. So I imagine that's what she's going to stay with, unless she wants to just act like Davos didn't happen.
I joked last week that we should send Mike McKee to the news conference. I actually think we should send Annmarie to this news conference, because the questions about the politics and her weighing in are not just an election, but the US election taking place outside of Europe is still kind of shocking.
It is shocking. It's also shocking because she worked with the former president when she was the head of the IMF. She had some good relationships with Donald Trump, his family members like Ivanka. But now she's weighing in. She said that the last comment she said at Davos, and there was a string of them weighing in on the former president if he was to take back the White House. The last comment was that Europe needs to go on the attack. That was what we heard from Lagarde. In other ways, we heard that from the German finance minister. We heard that from Emmanuel Macron. Europe is really having a moment where they're looking inwards in this mirror and really a reckoning of how they need to shore up their economy.
The euro right now, 108.87. Check out Tesla. Shares sliding this morning. Elon Musk looking to convince investors a new wave of growth is still ahead. The EV maker missing earnings estimates and warning expansion will be, quote, notably lower. Pressure on market share and margins also ramping up with increased competition in China. Musk placing his bets on a new low-cost car with a price tag closer to $25,000 by the end of 2025. Brahma, that stock is down by 8%.
Two takeaways for me. It's not very fun to be a car company. It's very fun to be a tech company. He's trying to shift gears and saying we're not actually a car company anymore because that's how bleak things look. It's hard to know how he's going to bring things around unless he becomes more of the tech side and less of the car side, because right now the car side is really pressured by China and, frankly, uncertainty about policy.
Oh, squeeze right on both sides.
Yeah.
Look, you've got a cost issue in the United States right now. given what's happened with UAW, and I'm going beyond Tesla, I'm talking about the majors, Ford, GM, Stellantis. Then you've got a price war with a Chinese manufacturer. You speak to David Baden of Citi. So two views, sell side, Dan Ives, okay, ultimately terrible earnings call, but still bullish. Speak to someone on the buy side, David Baden, Citi. He's talking about the sector being almost uninvestable right now because of the challenges coming from both directions.
And maybe that will change, right? Maybe in 10 years when all of the artificial intelligence and machine learning can sort of automatically create things, maybe we'll have a different conversation. But right now, he's not alone. And so at what point is Tesla valued as a car company and not as a tech company? Because right now, with the multiples that it has, as you pointed out, it is not being valued as a car company.
Tesla down hard in the pre-market. I want to finish on Boeing, facing a setback from federal regulators. The FAA freezing production increases for its best-selling 737 MAX jet amid the grounding of the MAX 9. However, the regulator is approving a new inspection procedure, putting the jets on a path to resume flights. CEO Dave Calhoun will address investors on the company's earnings call next Wednesday. AMH, you know this. He's facing questions not just from Washington, D.C., but from investors too.
Yeah, that's right. So he's going to have an earnings call, but he's also going to have a hearing in Congress because of what's going on. I find a little bit of confusing, though. The FAA is doing two things at once. It's one step forward in the sense that, in terms of safety, that they're making sure the 737 MAX production increases are going to be halted. But at the same time, they're allowing the airlines to inspect these aircrafts and get them back in the sky.
I hate this story, I'll be honest. I really do. And I'll tell you, because I don't want to be scared of flying. I want this just to be a given. I want it just to be like, you get in, you don't think about it, it goes up, it comes down, you're somewhere new. I just, how many times have we gotten this sort of a plane crashes and then we have to go on as media representatives and say, but it's really safe, et cetera, et cetera.
We don't have to do that if it's not.
But it's like, it's just such a frustration. I don't want to think about a lack of safety in the air.
And, so you don't want to talk about airlines?
Well, I mean, we have to talk about airlines. It's just I would like them to fix it.
We're going to talk about airlines right now. Alaska Airlines reporting better than estimated earnings, but saying it sees $150 million negative impact from the Boeing 737-9 MAX grounding. The FAA halting production of the company's most important model and laying out inspection procedures. The CEO, Dave Calhoun, on Capitol Hill yesterday, looking to ease concerns.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in. I'm here today in the spirit of transparency to share everything I can with our Capitol Hill interests and answer all their questions because they have a lot of them.
Brooke Sutherland of Bloomberg Opinion joins us now. Brooke, that line there, we fly safe planes. Does the regulator agree?
I think if you have to say we fly safe planes, then you've already sort of lost control of the narrative. And I think the FAA is not messing around when it comes to Boeing. I mean, this latest news is very serious to talk about pausing a production ramp. This is very key to Boeing's financial outlook, the ability to ramp up production and continue delivering these MAX jets. It still has a large number of them sitting in inventory from when this plane was grounded during the MAX crisis, and because of a lack of deliveries to China. It got some positive news on that front that it might finally be able to hand over some of these planes. But if it can't ramp up production, it can't meet that airline travel demand. And that is a big deal for this company. And beyond that, the FAA is auditing its production lines. It's looking into all of its quality control procedures. And I just think, when you start digging around in Boeing, given all of the challenges that we've seen so far, if the FAA is looking for problems, the odds are that they might find one. And I think that creates a risk that this is sort of a prolonged overhang on Boeing's 737 MAX.
Brooke, I've got a very basic question. Do we have any sense of what went wrong in Boeing over the past 5 years that created some of these issues?
I think it's possible that it goes back much longer than 5 years. I mean, I think this has been sort of a building issue, whether you want to go back to the late 1990s, like United CEO Scott Kirby did with the merger with McDonnell Douglas. If you want to go back to 2001 with the decision to move the headquarters away from the Seattle area factories that produce the 737 line to Chicago, and then they've since moved it again to Arlington, Virginia, which is closer to the defense business, but of course even further from Seattle. Or if you want to go, just into the way that they have handled the MAX crisis and sort of the reputational damage that has followed. I do not feel like we've seen that moment of deep-rooted cultural reckoning that should have happened to Boeing after those two crashes. And certainly should have happened before we got to this point.
How deeper can this inquiry go? Because Secretary Buttigieg yesterday said, quote, right now, everything is on the table. It almost felt like a threat, Brooke.
I do think that you have to think of every single aspect of Boeing's business as being fair game at this point. I think everybody is frustrated, whether it's the FAA, the transportation sector, the airline customers, certainly. And so I think every aspect of Boeing is going to be under a microscope. And that's why I say that when you start digging in and looking for problems, just given the sheer volume of manufacturing issues that we have had at Boeing, I just think that there's a lot of risk there for this company. I mean, the primary purpose of Boeing, why it exists on the commercial side, is to produce and deliver airplanes, and it has not been able to do so on a consistent basis.
It's a huge U.S. exporter. It's also a huge part of the defense, space, and security unit. That part of Boeing is incredibly important for the industrial complex. What does this mean for Boeing versus Airbus?
I mean, I think that's why everyone wants this ultimately to succeed. Boeing is a storied company, but it is a huge part of our economy. Like you said, it is a national champion. And that's why I think everybody wants Boeing to figure this out. And to Lisa's point earlier, the airlines want Boeing to figure this out. The flying public wants to get back to not having to worry about whether or not a piece of the airplane is going to blow off mid-flight. So everybody is incentivized to get to the bottom of this issue. But I think you can't do that unless Boeing really reckons with how we got to this point and starts with sort of a top to bottom overhaul of every aspect of its culture, quality control processes, safety standards, rooting out defects. I think that everything needs to be under a microscope, not just from the outside, but also from the inside at Boeing.
Brooke, I'm with you. This conversation is absolutely shocking. Just things you never want to say. We make safe planes. Brooke Sutherland on Boeing there. I just want to get into Southwest just briefly. It looks like, at first look, Bramo, a beat on the top and bottom line. We can get to the price action in just a moment. The stock is down by about 2.6%. EPS at 37 cents. The estimate is 12.
It's bouncing around. First it was positive, then it was lower. But what you are seeing is operating income in the fourth quarter coming in well above expectations, basically triple, 177 million versus the estimate of 42.9 million. Passenger revenue, just a slight beat. Earnings per share, a slight beat. But there really is a question here about whether they've turned the page on some of the issues that they had with some of their systems and a lack of technological kind of adaptation, John, that we were seeing with respect to just its systems with the breakdowns. Have they really moved past at a time where it's incredibly challenging for some of these low-cost airlines?
Here's the write-up from the team here at Bloomberg. The Southwest has again had to trim growth plans for the quarter in response to rising costs and an industry-wide glut of flights that's pulling down fares. Brooke has told us a few times that fares are actually coming down. Bramo, you and I have pushed back, but we can get Brooke Sutherland's view on this. Brooke, just how challenged are things right now for the airlines? Things look great at the start of last summer. Where are they now?
I think you had a situation where demand was so strong, and so the airlines chased after that. They added a bunch of seats. They had to hire a ton of people because their workforce was so decimated in the pandemic, despite, I might add, getting $50 billion in payroll aid from the U.S. government. But then they overdid it. And, you know, it's not that demand for travel has fallen off a cliff or the consumer is cracking or whatever that narrative might be, but there's just too much capacity right now in the domestic market. And that's why you're seeing that fare pressure. And the reason why that's so problematic is because the airline costs have also gone up in a significant way. We were talking about Boeing. You also have the RTX recall of their engines that affects a huge swath of the Airbus narrow-body fleet. That all means higher maintenance expenses for the airlines. They're also dealing with higher fuel costs in some cases, certainly higher labor costs, and that all leads to a squeeze on the profitability front.
Brooke, appreciate the update and the reaction to that as well. Brooke Sutherland there of Bloomberg Opinion on the latest with Boeing and Southwest as well. Southwest in a pre-market, just slightly negative. As you said, Bramo, dancing around just after the numbers come out in the last couple of minutes.
But they did talk about the rising costs that you were just mentioning, rising labor and maintenance expenses throughout the quarter. Just want to point this out. The carriers pilots just had this new contract that had a pay raise of 50% over the next 5 years. So, you know, this is really what we were looking for last year. And that's, I think, going to be the story here. When do some of these wage increases and other things really pressure margins in a more significant way? And maybe you're starting to see that come to the fore.
And at this point, they're negotiating with flight attendants. And if you're in a flight attendant union and you're looking at what the pilots got, you're thinking that you have a pretty strong hand to play. This
is all great when prices are going up and airfares are climbing and you've got pricing power. That's not where we're at right now for the airlines. It's a massive change from where we were maybe 18 months ago. That's the story for the airlines this morning. Equity futures on the S&P 500 totally unchanged. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former Treasury Secretary Robert Rubin warns the U.S. is in a terrible place with regard to its federal deficits.
I think the risks are enormous, and some of them are materializing already, like higher interest rates and effect on inflation, in part, not in full. And others haven't materialized yet, but I think they're out there and sooner or later will materialize if we don't correct our fiscal trajectory.
Rubin is calling for tax increases to address the deterioration. Pay for most senior investment bankers at Wall Street firms in Asia dipped below $1 million last year. That's the lowest level in almost 2 decades. Bonuses also took a hit. Compensation is crumbling as firms seek to cut expenses amid one of the worst deal droughts ever seen, fueled by rising political tensions and a crackdown on private enterprise in China. British billionaire Joe Lewis has pled guilty to passing inside corporate information to his private pilots and girlfriend. Lewis pleaded guilty to 3 counts of securities fraud at a hearing in federal court in Manhattan Wednesday. The former Tottenham Hotspur owner will be sentenced in March. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate the update. Up next on the programme, the ECB decides.
Monetary policy works with a lag. So whatever we do now is going to have an impact in a few months and sometimes a year or 2.
Looking ahead to the European Central Bank decision later on this morning. That's coming up next, live from New York City. Good morning. Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 just a touch firmer, up by 0.05%. Another all-time high to close yesterday. 5 days of gains on the S&P 500. Earnings looking better than good for Netflix. Not so much for Tesla overnight. That stock is negative in the pre-market. Yields are a little bit lower. We're down 2 basis points on the 10-year, 4.1549. Under surveillance this morning, the ECB decides.
What many people don't understand is that monetary policy works with a lag. So whatever we do now is going to have an impact in a few months and sometimes a year or 2. And we have to take that in account to decide what we do, how long we hold, and what decision we make in due course.
That ECB decision due out 8:15 Eastern Time this morning, with markets expecting rates to stay on hold for a third straight meeting. Bloomberg Economics expecting Christine Lagarde to push back on near-term rate cut calls. The focus will be on Lagarde's words relating to interest rate reductions in the press conference. Bramo, we forecast a rate cut at every meeting this year from June. That would total 125 basis points this year.
All right, I'm going to kill the kicker. We're not going to get anything today, right? I mean, basically, we're going to get a whole lot of word analysis because they're not going to cut rates. They're not going to basically raise them. So it's going to be 4%. Everyone is parsing through what they expect from Christine Lagarde. And Mark McCormick of TD Securities, his team, basically echoing what Bloomberg Economics is saying. Basically, nothing's going to happen today. And basically, the press statement should be exactly the same. But President Lagarde might want to push back a little bit based on the fact that she seemed incredibly dovish at the Davos meeting, those press conferences, and that seems to be the theme. What damage did she do at that meeting, and how much does she have to undo at this one with the little tweaks around the edges, the little smoke signals that she puts up at the conference?
We can talk about Boeing instead if you want.
It's okay.
ECB or Boeing?
I know, I'm grumpy.
We're going with the ECB. Sarah Hewen of Standard Chartered joins us now to discuss, not Boeing, Sarah, don't worry, we'll talk about the ECB. What are you expecting from Christine Lagarde in this news conference?
Well, I think as you've already described, we're not expecting any policy change, and that's very much in the market already. So it will be looking ahead. When are they going to start the rate easing cycle? How far does she reiterate what she said at Davos? Because, of course, it wasn't just Lagarde who was talking about summer rate cuts. We've had a number of policymakers, ECB policymakers, also talking about the summer as being the point at which it might be the right time to start the easing cycle. The same story applies, though, as has done in previous meetings. The jobs market is strong, unemployment is low, wage growth is running at 4 to 6% per annum. That's not conducive with inflation being at target. They'll want to see how wage settlement negotiations go over the next few weeks and months, and they're more likely to have a better idea in the second quarter about whether inflation sustainably is on the trajectory to 2%, or whether in fact this services inflation, which is still stuck at 4%, whether that's likely to stay high on the basis of high wage growth.
Sarah, that all sounds very appropriate and nice conversation points for Christine Lagarde today, and probably not what anyone is going to be listening for, because they're going to be listening for whether she says markets have gotten ahead of themselves, number one, and number two, what she has to say about Donald Trump. From your perspective, how much are those really going to be the key points in a press conference that, yes, where we are with wages, where we are with inflation, yada, yada, all that nice stuff is basically going to be forgotten because it's all been said before?
It has been said before, but I think she'll want to reiterate it. And she's certainly going to push back against market expectations, which have 2 rate cuts broadly factored in for the second quarter, although the expectations for the current quarter have largely faded away. So there will be pushback. On Trump, I mean, she's just not going to make any comments on the politics. So even though she may be pressed on that, and even though everybody will be waiting to hear, then that's not likely to happen. I mean, she'll be asked about the euro as well. And again, there's a standard response to that. So I'm afraid it is going to be the boring old economics and the boring old data dependency, and just perhaps in more granular detail about what it is specifically they'll be waiting for, especially on the wage front.
Sarah, you might have noticed Lisa's not excited about this one bit. Did Lagarde and the ECB do something to your cornflakes in Davos?
No, I actually think she has a tough thing. But to me, it's just all economics, right? And
Sure.
At this point, she can say whatever she wants, but people are just looking for these key issues. And then they want to see projections and the things that have come out. But otherwise, I mean, honestly, what could she say? It's basically whether she's going to slip up and say something political or whether she's going to say something that pushes back against the markets.
I can't wait to promote this news conference throughout the rest of this morning. Sarah, can we talk about how tight financial conditions are? We all know, based on experience, that the bank lending channel is far more significant and important in Europe relative to the United States. Here in the United States, markets are looking easy. Equities are at all-time highs, spreads are tight. We've got a lot of issuance coming through the credit market again. Just how tight are financial conditions in Europe?
Yeah, they are tight. And we had that bank lending survey, which demonstrated that was still very much the case. And it's been the case for quite some time. So what Lagarde has said previously about, that it takes a while before the full impact of policy tightening takes effect, that's very much being demonstrated in the lending data. If I could just note one other issue that may come up, which of course is what's happening to supply chains, what's happening in the Middle East. That's definitely going to be a question. How far does it affect Europe? Because the impact on Europe, which so far has benefited from falling goods inflation year on year for quite a long time, how far is the jump in freight costs and disruption to supply chains going to feed through to inflation? We already saw that impact in the purchasing managers' indices. Sentiment broadly is weak. How do they balance the lack of confidence in the economy, what the surveys are saying about the risk of the economy essentially dragging along in recession versus the inflation impact of the supply disruptions?
And amongst all those risks, there's also the fact that the IFO data this morning out of Germany, again, business confidence worsened in Germany. Is a rough start to 2024. This is the most important economy in the Eurozone. At some point, do they potentially need to change the timeline because of what is going on in the German powerhouse?
I mean, they will look across the board what's happening to all economies, and Germany has taken more of a hit in a sense than it's used to in these cycles because of its dependence on manufacturing and the impact that high energy costs has had. So we are seeing Germany again skirting recession and at high risk of tipping down into negative for 2 or possibly 3 quarters, according to the IFO data that we had this morning. That's not by itself going to influence the timing of a rate cut, but clearly to the extent that the whole region is struggling, and to the extent, importantly, that the labour market starts to show signs of distress as well, then that will be the point at which policy easing looks more likely.
Hey, Sarah, thank you for your insight. Sarah Hewen there of Standard Chartered. Have we got the promo somewhere? I can bring that up on the screen. I can promote the decision. 8:15 Eastern Time. The ECB decides 30 minutes later. We'll have a news conference with Christine Lagarde that Bramo tells me is going to be absolutely gripping. Gripping. We're going to take it right here live on Bloomberg TV.
It might be really gripping, okay? But I'm just saying, at a time where the economic data is inconclusive and people just keep repeating the same thing over and over again, people are looking for slip-ups. It's essentially what people are looking for. Am I wrong?
You're not wrong. I think it's all about the news conference. I think the decision is likely to be boring. How much has changed, given what she said just last week? But the news conference, given the pushback inside we're seeing from the central bankers that work there, the staffers at the European Central Bank, the mutiny. Do you want to really jazz it up? That one.
Thanks.
OK, two, the politics. Annmarie, the politics. The fact that we've got an ECB president that's willing to weigh in on the politics, not in Europe, but abroad.
And not just once, and then decided, you know, I have another opportunity in Davos, let me walk it back. It started the Friday before Davos in an interview at France 2, saying Trump is a threat. Then she went on to when Francine Lacroix asked her and said, well, actually, let me take a drink of coffee. And then later that week said, actually, Europe needs to go on the attack because we're worried about Trump. I imagine ECB reporter is just going to ask this simple question.
Yeah.
Is it appropriate for a central banker to weigh in?
It's round 3. In the next couple of hours. Coming up in the next hour, senior White House advisor Amos Hochstein, Paul Talman, the CEO of PJT Partners, the brilliant Liz Ann Saunders at Charles Schwab, all of that and more. This is Bloomberg.
We're just at the very beginning of heading back towards normal and what normal would be.
My feeling is inflation still comes down. I think we're in the camp that says that we're in a declining trend in inflation.
It is possible that inflation just comes down and we don't go into a recession. But is that the likely case? No, it never has been likely.
Things could change and move around pretty quickly.
We're not out of the woods yet in having a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just about positive by 0.1% following a 5-day winning streak on the S&P, the longest winning streak of the year so far. A couple of names to talk about. We can talk about Tesla and Boeing in just a moment. Let's start with the big one. I'm going to try and promote this. An ECB decision coming up in about an hour and 15 minutes. Bramo is about to fall off her chair with excitement about it.
It's going to be incredible. Nothing is going to happen. They're not going to move, and they're going to try to not indicate that much. What's going to be interesting, as you've pointed out, is the press conference. Does she get into politics? Does she say something wrong? But essentially, the fact that we're here, that basically people are looking for slip-ups, tells you that things are kind of on hold, and people can sort of angst around this, but we won't know until we know exactly what their path is and what the economic trajectory is.
So she's been criticised within the central bank by the staffers about maybe not being the greatest leader, the greatest boss. I would say on the governing council, they believe she's a consensus builder. So let's talk about people on the governing council right now. Philip Lane, her chief economist, basically said you've got to wait until June to get a feel for what's going on with wages. Hasn't he just told us that he's not willing to do anything until the middle of this year?
Even so, 64% chance being priced into the market right now of an ECB rate cut in April. So not necessarily buying what they're selling. Here's a key question, and actually Sarah Hewen outlined this in a very good way. I am curious to hear what she says about the Red Sea and some of those disruptions. In the U.S., people are saying it's not going to necessarily jack up prices. In Europe, it's a very different story because that really is the major supply chain channel. So that could be interesting.
A lot of those goods that go through the Red Sea actually are destined for Europe, and they're adding a ton of fuel money and a ton of time to go around Africa. And what we've seen is that the U.S. Department of Transportation has told vessels to avoid the Red Sea, to avoid the Gulf of Aden. And until that starts to temper down, you're going to see this play into the supply chain. At some point, it's potentially could hit inflation.
I think Lisa got it done there. 8:15 Eastern Time. That was
Thank
perfect.
you.
Yeah,
I
I'm looking
appreciate
forward
it.
to
The Spark Notes version.
30 minutes later,
As opposed to
you're
before.
going to get a news conference. I mean, before that was quite something in a previous hour, but we'll try and forget that. Let's take a look at Tesla in the pre-market. The stock is down by about 8%. We've heard from the South side. I think they've called the outlook vague, left in the dark, on their own for the next 12 months, trying to figure out what earnings are going to look like.
I got to say, the fact that Dan Ives, the key bull in technology, the bull on Tesla and everything else, coming out and saying it was a preschool press conference, that he didn't get it done, that it basically was not an adult. is sort of an understatement, gives you a sense of where we are. The fact that we're talking about a company now that he doesn't want to run. He wants to run a tech company, not a car company.
Stock is down by about 8% at the pre-market. The broader price action, equity futures, let's touch base on that. The S&P 500 just about positive by 0.1%. Yields are lower by a basis point or two. 416. I've talked about it twice. You've talked about it twice. Auctions, they matter, Bramo.
Honestly, yesterday the 5-year auction was so exciting at 1 p.m.
It was sloppy. It wasn't good.
It wasn't good. Today we've got a 1 p.m. auction. At a certain point, you got to wonder, everyone talks about deficits, everyone talks about the political backdrop. When does it actually start to matter and we get the pushback? And people say it's going to be next year, it's going to be the year after, it's not going to be for a while. And then we get a sloppy auction and people are saying, oh my God, the deficit. So at what point does that story have some legs?
416 on a 10-year. More of that coming a little bit later. Coming up over the next hour, Paul Taubman, the chairman and CEO of PJT Partners, joining us around a table. Looking forward to that. Sheila Kahyaoglu of Jefferies on airline earnings. We heard from Southwest a little bit earlier this morning, and Alaska Air as well. Southwest is just about positive now by 1.6%. And then we catch up with senior White House advisor Amos Hochstein on record crude production, and AMH 13 million is the number we're going to mention a few times with that man right there.
It's a record on any country ever, what the U.S. is producing, yet the Biden administration does not like to talk about it. It's like a secret that no one wants to talk about in Washington, but it's also part of the reason why going into an election year you have gasoline under $3 a gallon.
Yep, he's going to be talking about it later on, that's for sure.
We're going to force him.
Let's begin with our top story this morning. Counting down to US economic data, GDP, core PCE and jobless claims 90 minutes away. Investors hoping for more clues on the Fed's rate cut timeline. Bank of America and Goldman expecting the first move to come in March. Citi, Morgan Stanley have the Fed waiting until June. To talk about the outlook for investment banking and a whole lot more, Paul Taubman, the CEO of PJT Partners, joins us around a table. Morning, Paul.
Good morning.
The investment banking recession, sir, is it closing? Is it ending?
It's beginning to warm, but it's going to take a long time. It's going to take a long time. We've had the punch bowl. We've had incredibly easy money conditions, zero interest rates. We've taken the punch bowl away, and markets haven't fully adjusted.
Do you think a couple of rate cuts make a difference to your world, this conversation that we have every single day?
They do. They do. The reality is that rates right now are coming down. The only question is when. And I do believe that it's going to be pushed out further. And until we start to see actual rate cuts, I think it's going to be difficult to really get the financial markets, the M&A marketplace moving.
You said something there that I think is really telling. You said the punch bowl has been taken away, but it takes time for it to adjust. It's sort of the long and variable lags that we've debated for about the better part of about 3 years. Do you think that there is a mountain of reckoning in valuations that has yet to taken place in your space, in private equity, in sort of some of the deal space?
Well, let's look at it. So if you go back, you've had a global M&A market that's $4.5 trillion, year in, year out, plus or minus $4.5 trillion. All of a sudden, COVID, market shrivels up, $3 trillion. Fed comes in, rates go to zero, $6 trillion. Now, the punch bowl is taken away, 11 rate hikes, $3 trillion. So we've gone from 4.5 to 6 to 3. And now the question is, how do we get this marketplace started again? And when you think about it, a lot of that is private equity involvement has dried up. And when you look at how active private equity has been and how much they've hit the sidelines, that I think is what people don't fully appreciate. And until private equity gets more forward-leaning, until they're prepared to sell a lot of the assets that they have, until they're prepared to recycle that capital and make new investments, I think you're going to have this stuck environment.
So what kind of haircut are we talking about? Because essentially it's a price issue. They don't want to take a 20% haircut, a 30% haircut. They don't want to lose money. How much are they going to have to in order to get this market moving?
Look, one thing about private equity is they are exquisite at controlling exit timings. And they have long runways. And that's why I think this is going to be a very, very slow build back up. And when you think about that large a constituency being that active in the M&A marketplace, and now all of a sudden they're controlling their exits and they're pushing them out and they're not returning capital to investors. And all of a sudden the capital that's being called is greater than the capital that's being distributed. The IPO markets have been tight. So there's very little in terms of monetizations in the IPO marketplace. The credit markets have constrained dividend recapitalizations. There's a bid-ask on private equity assets as far as monetizing. So we're going to work our way out of this. So when you ask me about the recession, it's been an M&A recession. It's been an investment banking recession.
Yep.
I think many of the conditions are in place to start that recovery, but it's not going to pop back up. It's not going to do so immediately, but I think we're starting to get there.
This is your world. Help me understand it a little bit more. You mentioned M&A, so let's talk about that. If I'm a company right now, am I waiting to see what happens with the politics before I go out and do a big deal, a big acquisition?
The political environment that we're now in an election year, that's going to dramatically increase the volatility in the marketplace. I don't think that's appreciated to the full extent today. As we get further into the year and closer to the election, my sense is you're going to see the pause button hit on a lot of transactions. So in a way, we may see a catalyst in the IPO market where companies want to come to market early in the year and not wait. I think you're likely to see more M&A activity in the first half of the year. People are likely to hit the sidelines later. And then once the election is over and we understand the direction going forward, I think you're going to have a pretty robust snapback.
Hasn't JetBlue and Spirit, that potential merger that is blocked, and we see the way the Biden administration thinks of antitrust laws, hasn't that just said to the M&A market potentially maybe wait till 2025 and see if the political environment changes?
The reality is that relatively few transactions get caught up in the regulatory review, but it has a chilling effect on those. And we tend to focus too often on the deals that get reviewed, the deals that get blocked, and we don't focus on all the deals we never saw that never got brought to market because of a fear of an elongated review process.
Interesting.
And in a world where it's incredibly complicated, where valuations are moving, to be on the sidelines for 12, 15, 18 months, that's an opportunity cost that's really sort of caused a lot of companies to say, you know what, I'm just going to wait for another day.
So how many rate cuts are necessary before it gets things moving? Is it basically walk back half of them, 5 rate cuts, and then things really go crazy, or is it 2?
I think the first critical inflection point was when we stopped the hikes. And it's not a coincidence that the depth of the market was when we were still hiking, and you started to see a small rebound, some green shoots, when it was clear that we had hit stasis. I think the next leg in the recovery is when you actually start to see cuts. And I don't know if it's 1 or 2, but you just need to see some conviction that we've crested and we're on the way down. And I think at that point in time, things open up significantly. It's easier to get the bid-ask spreads narrowed. I think people have more conviction that if they're leaning into assets, they're going to end up with good deals. I think people are more comfortable starting processes because they know that there's some momentum, some tailwind behind. And right now, it's like 2 boxers sort of circling one another.
How important were the energy deals of the last few months just to get that process started, to get things moving?
Well, that was a very large component of this rebound in M&A has been these large energy deals. And you've got all these shale producers. There's excess capacity. There needs to be consolidation and rationalization. You've seen some of it. I think you've seen the biggest of it, but you'll continue to see consolidation in the space. But there's no doubt that those were 2 of the very few mega deals that we've seen in recent times.
Is that the number 1 industry for you right now where you'd expect to see a lot more?
Look, I start with places where it's cash buyers, strong balance sheets. So that leads you to healthcare. That leads you to energy, that leads you to consumer, that leads you to tech. But what's happened also is with these seized up credit markets, there are a lot of companies where in order to take them over, you have change of control, you've got to refinance the entire debt stack. When you've got a debt stack that you're not sure you can refinance, and if you refinance it, it's a meaningfully higher cost, all of a sudden it's more and more difficult. So cash buyers, strong balance sheets, Those are going to be the industries that are going to lead us out of this.
I know what Bramo's thinking of right now. We're going to talk about it in the next segment. You're thinking big egos and media.
Oh, yeah, big time. I want to see, who's going to buy Disney, is Apple going to buy Netflix, but he's not going to talk about that.
Paul,
but,
it's good to have you with us. You're going to stick with us. Paul Taubman there is going to be sticking with us to talk about this a whole lot more. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla shares are falling this morning despite Elon Musk talking up a growth wave in the form of a new low-cost car next year. Musk's comments come on the heels of a disappointing earnings report. The EV maker missed estimates and warned of a, quote, notably lower expansion this year. Shares of Paramount, meanwhile, are rising after reports Skydance Media's David Ellison has made a preliminary offer to buy National Amusements. That's the holding company of the Redstone family. National Amusements controls 77% of Paramount's voting stock, and Ellison has already held discussions with Paramount chair Sherry Redstone on the terms of a possible deal. Home prices in New York's Hamptons are soaring to a new record. That's according to data from Miller Samuel. Properties went for a median price of $1.85 million in the last quarter, a 45% jump from the same quarter a year prior, more than double pre-pandemic levels. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Coming up next on the program, looking for a broadening out in the equity rally.
Is this going to be a rally led by tech? Now, more and more, we're starting to see, beginning November last year with the Fed pivot, people playing for potential broadening out of that rally.
That's coming up next on the program, live from New York City this morning. Good morning. New York City, stocks are positive by almost 0.1% on the S&P 500, higher here by 0.06. Yields are lower by a single basis point. Your 10-year, 416.45. Under surveillance this morning, looking for a broadening out in the equity rally.
Is this going to be a rally led by tech? Now, more and more, we're starting to see, beginning November last year with the Fed pivot, people playing for potential broadening out of that rally. We have S&P at all-time highs, but Russell's still down 20% from its peak, right? So Russell's still in a bear market. So that's kind of where the potential catch-up is, and that's where we're seeing the most elevated demand.
Stocks hitting all-time highs, and Liz Ann Saunders of Charles Schwab seeing further gains possible if market breadth firms up, writing this. There is no hard and fast rule stating that cash must be put into the equity market. For investors who might be looking for more stable streams of income, several pockets of the fixed income market look attractive. The brilliant Liz Ann Saunders, Chief Investment Strategist at Charles Schwab, joins us now. Liz Ann, let's get into it. 2 points there, where the cash is going to go and the potential to get some breadth here in this equity rally. What have we learned from earnings season so far?
Well, if you stop at the typical metric that gets focused on, the beat rate, that's not bad, 80%, although that's been trending down, but 80% is still above recent averages as well as long-term averages. But I think the focus is more on things like net profit margin overall for the S&P 500 is looking to be down in the 10% and change. That's down from more than 12% in the third quarter. And there'd been some hope that that pickup in the third quarter was the beginning of a trend. That doesn't seem to be the case. And then estimates came down quite a bit since October for Q4, but they've also come down for all 4 quarters in 2024. And with the forward earnings easing, you've got a bump up in the multiple. And so I think there's still a little bit of a multiple problem. Although X the Magnificent Seven, the S&P, instead of trading at 20 times forward earnings, is only 17 times earnings. So that's where the valuation bias on the upside has come from, obviously.
Liz Ann, are you basically just saying big tech is overvalued?
Well, it depends on what big tech. If you look at the factor level and you look at Magnificent Seven, for the most part, they do check the box on things like interest coverage and strong free cash flow. But you're seeing a broadening out even there. As of 2 days ago, I didn't look at the rankings. You still had NVIDIA as the number 2 best performer year to date, but you had to go all the way down to the 500th ranking to incorporate all 7 of the Magnificent Seven, with Tesla bringing up the rear. So you may not be seeing the broadening out if you just look at tech as a traditional sector, but if you look at the dispersion that's happening in the Magnificent Seven, it tells you that something is brewing, that there is money looking for opportunities outside of that very small subset.
I'm struck by the fact that you think that there's opportunities in fixed income as opposed to some of these stocks that are particularly expensive. Where, given that a lot of credit in particular is pretty expensive too, if you just look at the spread compression and how much people have baked in this soft landing?
Yeah, and you know Kathy Jones very well, my colleague, who's our fixed income guru. But I think there are opportunities, not necessarily into things like high yield. I think there's probably a decent amount of risk there, and that's something Kathy has been talking and writing about. But potentially still some opportunities in higher quality investment grade, not to mention the yield pickup that you can get in treasuries. You know, one of the interesting analyses that's been occurring is around the money flows that could go from money markets into equities. And I'm not sure that is getting sort of fully understood. You've got $6 trillion in money markets, and that's seen as potential fuel for the equity market. But I think that's probably fairly sticky money, not to mention that although that's a record in level terms, as a percentage of overall stock market capitalization, it's actually on the low end of the historic spectrum. So I think you've got these pockets of money you have to consider, the sort of cash-oriented money that might actually be quite sticky, money that wants to take advantage of some opportunities in fixed income, and then sort of your equity bucket. And I don't know that we should be blending them.
Lisanne, you've got a pretty original take on what's been happening with small caps. There is this proposal on the Trump campaign of maybe some big tariffs just around a corner in our future. Do you think that's starting to have an impact on small caps already?
Well, you know, the day that Trump Trump campaign officials were floating that out as a possibility, you did see a lift in small caps. Now, maybe that wasn't the sole reason. I think it also had to do with expectations around Fed policy and short-term moves up and down that you get in yields. But, when you're in an election year, we don't put a lot of weight on just the election or looking at averages of performance in election year, but you do tend to see trading kind of movements at the sector level, certainly things like defense or healthcare. But I think in this case, any discussion about tariffs, given small caps have much more of a domestic focus, that could be a short-term needle mover. But I wouldn't suggest trading around some short-term trends as it relates to prospective policy, certainly not this early in an election year.
We're also joined by Paul Taubman, which was wonderful to have you on here. And I'm curious if you've heard from the management teams of a lot of companies that they are kind of gaming out what their balance sheets look like depending on which policies, which tariffs get implemented.
Yes, I think it's a real issue that this election is going to introduce an extraordinary amount of volatility into the market. When you think about the last two elections were decided by literally tens of thousands of votes. I am assuming that this election will be razor thin as well, and to have two competing policy platforms where there'll be uncertainty as to which direction we're headed, what the fiscal, monetary, what the economic overlay is going to be, approach to China, tariffs, protectionism. That introduces volatility. You layer onto that a campaign where there's an increased risk of some foreign testing of the United States, some incident which creates some geopolitical risk. You add on to that the fact that I think it makes the central bankers less likely to take rates down, wanting to be seen as apolitical. You add into that the risk of a disputed or contested election. And I think we are headed to meaningful uptick in volatility. And when I talk to clients, they sort of understand it. They're preparing for it, but it's not really front and center. And I think that wall of worry is one we're going to climb.
Yeah, I'm with you. We hear the same thing on this program. I think people just want to ignore it. They know they can't, but it's still early enough in the year where they can get away with it. Lisanne, you mentioned that maybe it's a little bit too early. I want to give you the final word on that. What would you expect to develop in the second half with all of that in mind?
Well, I do agree that there's going to be some volatility, but ultimately, as it relates to policy proposals, it's not only things like how razor thin the election might turn out to be, but of course what the makeup of Congress is and whether there is a majority and how narrow or wide that is. That's ultimately the deciding factor in terms of what policy proposals can be put forth. But I think there's a likelihood of a pickup in volatility anyway, maybe a shift from volatility being all on the fixed income side of things last year to a bit more on the equity side. You got volatility so low that to some degree it's just a simple reversion to the mean. You can only go so much lower before you see it turn back up in volatility. So a higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption as we continue in this year.
Lizanne, you're one of the very best. Appreciate the catch-up. Lizanne Saunders there at Charge 12 with the latest. I keep going back to that RBC quote. Laurie Calvasina talking about the election with clients, staring at the sun. Everyone wants to ignore it. They know they can't, but they can at the moment for the next maybe 2-3 months.
Well, because how do you price it out, right? How do you understand? You just buy sort of protection against volatility? How do you understand when in the past elections, the first knee-jerk reaction has always been wrong, right, in markets? So how do you prepare this? And I think that lack of certainty is the reason why people aren't directly addressing it just yet.
Also, we continuously discuss on this program what this 10% tariff wall that Trump has through the press reports have said potentially he'd be looking into as a plan. But we asked Gary Cohn, who worked for him, and he pretty much shrugged it off that, I don't really know if that would be happening.
Will there be a Gary Cohn in the White House?
That's the question.
To stop it from happening. I mean, that's going to be the interesting part of all of this. What does the team around President Trump, if we get President Trump, actually look like? Equity futures on the S&P 500 just about positive. Live from New York City this morning. Good morning. Five days of gains on the S&P 500, 4 consecutive all-time highs. Equity futures on the S&P look like this, positive by 0.07%. The Nasdaq 100 up by 0.16. The Russell of small caps continue to bounce, up by, let's call it 0.25%. Into the bond market, 2-year, 10-year, 30-year, going into jobless claims in about an hour from now. Yields are a little bit lower by a single basis point, 416.65 on a 10-year. In foreign exchange to finish on the euro, the ECB decision 45 minutes away. Bramo, so excited. The euro right now just sat at 109. That currency pair is totally unchanged at 108.88.
Okay, am I not speaking for you as well? I mean, let's be honest. This is just not going to be.
I just enjoy winding you up. I'm totally on the same page. I mean, it's going to be so boring. I'm with you.
Yeah, it's going to be awful until she speaks, and then people are going to wait for her.
I don't know if I'd call it awful.
But no, not awful, but it's going to be, what you expect until she speaks.
Sure. Under surveillance this morning. I agree. A crucial win for Joe Biden's re-election bid. The president securing the endorsement of the United Auto Workers, a major boost for Biden, given the union's influence in the battleground state of Michigan.
And this choice is clear. Joe Biden bet on the American worker, while Donald Trump blamed the American worker.
Let me just say I'm honored to have your back and you have mine. That's the deal.
Last year, Biden became the first modern president to visit a picket line during the UAW strike against Detroit's Big Three. That support, AMH, cuts two ways. It's not just that they've put the support behind Biden. That is clear and obvious opposition against Trump.
Yeah, absolutely. But this was bound to happen for Biden. But we cannot explain to our viewers how important this really is. Not so much the UAW backing, but Biden needs to get the rank and file. Michigan is critically important. He won it against Trump. But remember, Trump beat Hillary Clinton in Michigan by 10,704 votes. That is why this is so important. But he's really got to get out beyond the top brass, the Biden campaign, to the rank and file.
I got to say, it's a messy moment. I was in an Uber this morning, and the Uber driver was talking about groceries, and he was talking about how expensive things have gotten and how frustrated he was and how worried he is about cost of living. And so how do you measure the dissatisfaction with that, with the need to increase real wages, which has happened to some degree, but now is actually pressuring the margins of so many companies? It is a tricky economic moment. When it comes to messaging, it's even more complicated because which constituents are you speaking to? So at this point, this is what you're working with, nuance, and that doesn't play in politics.
So, Paul, let's talk about it if you can. Do you sense the power is shifting and it's moving away from capital to Labour? Is this just a moment in time, the last 12 months, that big UAW agreement, or is this a real regime change?
I think it's a moment in time. I think it's a moment in time.
Why is that?
I think I think COVID was an extraordinary point where all of a sudden we snapped back, hiring through the roof, trying to get workers back to factories, getting workers back to the office, shortages, disruptions and the like. But I think we're sort of getting back to a more normal world. And the reality is with AI and where we're heading longer term, I think that's going to really start to change the equation, and you're going to end up with dislocations in the labor force that we haven't really contemplated heretofore.
Which industries in particular are you expecting those dislocations at a time where you do see a lot of restructuring as a response to some of the machine learning?
I think it's going to be everywhere. And I don't think we fully appreciate just how profound it's going to be. But I think it's something that we're going to have to confront on so many levels from a societal perspective. But when I think about it from our firm's perspective, and I look at how much value has moved into a handful of companies, we're talking trillions of dollars. That's not all going to be win-win. There's going to be creative destruction. There's going to be significant pain felt as the balance of power shifts. If you just look at what big tech was able to do to disrupt the advertising market, and you then start to think about this exponentially as it plays out, it's profound.
Have you thought through the political ramifications of all of that? We were in Davos, Switzerland last week, and it's called Happy Valley for a reason. Some of the happy talk around AI and this idea that it would complement jobs. And I'm not convinced, and I'm sitting here waiting to be convinced. There is a feeling, a fear, I would say, that AI could do to services what globalization did to manufacturing in America. Just huge job displacement and massive, massive issues for decades.
And I think part of it is we're just in the early stages of imagining where this can go. But if you just look at the curve and the rapidity of the progress and the speed with which this happens, it sort of doesn't appear, and then all of a sudden it's in your rearview mirror and it's gaining on you, and you're transformed. And I think that's where we're headed. I don't know whether it's 5 years, 10 years, but at some point it's going to be profound. And that's why I think that, plus the unique moment of the COVID era, I think moves the balance of power back to labor. I think we're probably getting to a different equilibrium.
Fascinating, absolutely fascinating. Let's talk about Tesla as well. I want to bring up shares in the pre-market just briefly. We are negative by something like 7 or 8% through most of this morning, down by around about 8% right now in the pre-market, with the EV maker warning of, quote, notably lower expansion this year and opting not to publish full-year targets. Elon Musk trying to convince investors to look past that, talking up a cheaper model of car that the company plans to start production on next year. Let's keep it brief, Bramo. No one's buying that this morning.
Is this a car company or is it a tech company? Elon Musk wants it to be a tech company. People are worried that it might just be a car company. And it really raises this issue. Are car companies kind of not uninvestable, but really tricky to invest in at a time where that transformation that Paul was just talking about is happening in real time with electric vehicles, with some of the demand? And that, to me, is sort of one of the big questions for Ford, for GM, but also for Tesla.
A transformation in the media space as well. Listen to this. Streaming service Peacock picking up 2.8 million new subscribers with its broadcast of an NFL playoff match earlier this month. According to research firm Antenna, the match between Kansas City and Miami was the first playoff match to ever be broadcast exclusively on the streaming network. Antenna saying it was the biggest live stream event in US history. AMH, I've got one question. If you signed up, do you stay signed up after all is said and done?
I think by accident you do. You don't mean to. You signed up to watch a game, which, by the way, I signed up once for Paramount to watch a Juventus game because John's like, you got to watch this. It's incredible and it's worth the subscription fee.
Still signed up.
But I'm still signed up because you forget and you move on with your day. So I think it bodes well for some of these streaming services. But also, I imagine some of those eyeballs were not just NFL fans.
Have you got thoughts on media that you want to share?
Look, I think the fact that the NFL was prepared to take an important playoff game and put it exclusively on streaming and deal with all of the backlash because it wasn't universally accessible, that's profound. And I think you're going to see more and more content move direct to streaming. And once you get that flywheel going, you don't turn back. So this is the technology. This is where you're headed. And right now you've got a proliferation of streaming platforms. You've got selected content in different places, but at some point, this is going to be much more comprehensive service offerings, and this is going to be where consumers go first.
Who are the big winners and who are the big losers?
I mean, clearly Netflix is an extraordinary winner in all of this. I think Apple is a winner in all of this. I think YouTube has the opportunity as well, Amazon. So that's where a lot of this has gone. And the question is, what's minimum sufficient scale to play in this game? And if you're a traditional media and you have legacy linear assets, can you afford to make the pivot? Do you have the staying power, and do you want to go head to head?
It's their Kodak
with these
moment.
giants?
It's their Kodak moment, right? They've got to work it out. Do they sit there and get killed or make the move? That's what it feels like to me, Bramo.
And who are we talking about? Disney? Are we talking about, all of the traditional networks?
I'm thinking of the guys with the big linear networks that Paul is talking about, who are nervous about making that move. Let's take CNN. So they come out with CNN Plus. Doesn't work out. So they're stuck with where they are, and they're still trying to figure out the future, as many of these companies still are.
Well, but to Paul's point, is it YouTube? How are people even getting their news? I mean, it sort of feels a little bit too self-reflective, but there is a sort of question of, what is the model of information and this transformative Kodak moment?
Let's turn to Boeing and the airlines. Let's catch up with the latest on American Southwest and Alaska reporting earnings on the heels of a halt to 737 MAX production plans. Alaska reporting better than estimated earnings, but seeing a $150 million negative impact from the MAX 9 grounding. The company's CEO saying, quote, "We remain steadfast in our commitment to safety in the midst of a challenging start to 2024. Sheila Kahyaoglu, the Equity Research Managing Director at Jefferies, joins us now for more. Sheila, let's get into it. Last time you and I caught up, you were optimistic, dare I say constructive, on the prospect of this plane getting back up into the sky pretty quickly. What's changed in the last few weeks?
Thanks so much. I'm still optimistic as the FAA is warranting the return to service of the MAX 9. And the aircraft is getting, will be back up in the air. I think United said potentially as soon as Sunday. But the FAA has put out a notice requiring more thorough inspection and maintenance processes for ongoing production of the MAXs. So that's what's really changed here. The FAA is taking more of a stance, putting out a warning to Boeing. And investors this morning are wondering not so much about the MAX 9, given it's only 2% of the backlog, but really what happens here for the MAX 8 production and the MAX 7 and 10 certification that is upcoming at the end of this year.
Sheila, when do you know we've hit a bottom for Boeing?
So the way I think about it is Boeing's lost about $20 billion of market cap in the last 20 days. And so the market's actually been realistic. It's taken out at 6% free cash flow yield, about $1 billion to $1.5 billion of free cash flow out of 24 numbers. And that's probably what we're going to see when Boeing reports in terms of how they're going to guide, in terms of what they're going to say for MAX production. The long-term story on why we're so bullish is really the pricing element, not only on the MAXs, which obviously is the biggest driver of this story, 60 to 70% driver of this story, but also the 787 as well. Better pricing on aircraft that are delivered in 2026 and beyond. But of course, when you have Alaska out there, as well as Scott Kirby at United, negatively talking about the MAX 10 and publicly negotiating contracts, it does not, it puts some pressure on Boeing there.
Sheila, do you see the likes of Ryanair cancelling any of these contracts anytime soon?
To be frank, no. But especially given their Southwest and Ryanair, their dedication to Boeing and their single fleet just optimizes their structure. The MAX 10 is very important. So why is the MAX 10 important? One, it represents 25% or so of the skyline going forward once it's certified and in full ramp in 2026. Second, it's really important to U.S. carriers. Why is that? The MAX 10 seats about 10% more passengers than a MAX 8. So it really helps drive the upgauging theme that United Next has at its analyst day that it laid out in 2021. Because the only way to grow in domestic markets is really to carry more passengers on the same route or to open up new routes. So that's really what investors are looking at.
Hey, Sheila, we've got to leave it there. Appreciate the update. Sheila Kahyaoglu there of Jefferies. Up next on the programme, US crude output at all-time highs.
The U.S. is pumping more than 13 million barrels of oil per day. Do you think that that's a policy failure or a policy success?
It's a policy necessity.
We talk about that necessity next on this programme. The reaction from the White House just around the corner. Live from New York City this morning. Good morning. Equities just about positive on the S&P 500. Under surveillance this morning, U.S. crude output at all-time highs.
The U.S. is pumping more than 13 million barrels of oil per day. Do you think that that's a policy failure or a policy success?
It's a policy necessity because you obviously can't shut down the economies of the world and be ridiculous in sort of saying, oh, okay, we don't, you're going to affect demand without affecting supply at the same time. You've got to have a broad approach. That's what the administration is trying to do.
Well, here's the latest. U.S. oil production at record highs, more than what was produced during the Trump administration. AMH, we are through 13 million barrels a day.
Yeah, absolutely. A record for any country in the world. It's happening in the United States. This is a little-known secret in Washington, D.C., because the Biden administration doesn't like to talk about it. Liam Denning, writing in a Bloomberg opinion piece, said, whether you prefer fossil fuels or clean energy, there's much to like with where the U.S. stands today. Sure, climate deniers. They won't like the Mune music, regardless of record oil and gas output. Biden's bigger issue, though, Jonathan, however, could be with the left of his own party, for whom all the above energy is a cop-out rather than a practical means of maintaining momentum for the transition.
Amos Hochstein can't wait to talk about this. The White House senior advisor to the president for energy and investment. Amos, good morning to you.
Good morning.
Is that something you're proud of? 13 million barrels a day? Is that a good thing?
Look, I think what we're proud of is the overall energy record that the Biden administration has had over the last 3 years. And that is, coming in, the president said very clearly, I'm going to be the most pro-climate change action green administration we've ever had. And he's worked really hard with Congress to pass important legislation, the Inflation Reduction Act, the CHIPS Act, and the Bipartisan Infrastructure Act, all with major investments in clean energy. But it's an energy transition. And what we have to be able to do is to do two basic things at the very same time, which he believes the United States can do. And that is to accelerate the energy transition, to use government purchasing power, investment and incentives, tax and other, to bring about that acceleration in the energy transition, while at the same time making sure that we control and manage a strong economy in the United States for American consumers and around the world. And I believe that we've done that quite successfully and have allowed gasoline prices to come down, which has helped food prices to come down because we are a farm to truck to table, not a farm to table. And we've also at the same time been able to accelerate the transition. So we've done that, and by bringing the our energy policy there under control and managing it well, it also helped in bringing overall inflation down and supporting a very strong economy that we have today.
Amos, this is the domestic story. We also have Russia still shipping energy. We have Iran every month putting out, at least at this month, more than 800,000 barrels, most of that going to China, and Venezuela oil hitting the market. At one point, is the U.S. allowing lower gasoline prices at the effect of allowing adversaries to make money off of it?
We're not. Let's tick off what you just listed. When Russia invaded Ukraine, we had a very clear policy, and that is we wanted to allow the Russian crude to continue on the market because taking it off the market would actually punish European consumers, not Russian consumers. So allow it to be. But we launched the price cap in order to make sure that what matters most is how much revenue Putin gets, not how much oil is sold. And that was our goal. It worked very well at the beginning, kind of had a little bit of a resurgence of oil prices for Putin. We had to adjust to it, as we always do with sanctions, and we've brought it down again. So we have exactly what we wanted, is the Russian oil on the market, but lower revenues. So he gets significantly less than what oil is traded for. And in Venezuela, look, there's been almost no increase in oil production out of Venezuela. There's been some changing of Venezuelan crude from going to China to going elsewhere. But it's basically the same at a fairly low level.
But what about Iran? Will the U.S. start to enforce some of these sanctions on Iranian oil?
If we weren't enforcing sanctions on Iranian oil, Iran today would be back to where they were before sanctions, which is at about 2.5 million to 3 million barrels a day. They have enormous amount of reserves and resources. And the reason that they're not doing that is because they're under sanctions. So yes, sometimes we are able to bring down their exports to 1 million or 1.1 million, and sometimes it goes to 1.4, like it is right now, 1.4, 1.5. So those are a bit seasonal, but by and large, they are under extreme sanctions. They are not able to develop their gas sector, even though they're one of the largest reserves in the world, and they export nothing. So I think that we're doing pretty well with that, making sure that our adversaries know that if their actions are... Sorry, go ahead.
No, I'm just struck by this idea that we talk about OPEC Plus and how it's losing all its relevancy because of how much oil the U.S. is pumping. And there's this question, I mean, not relevancy, but they're concerned about the plus and then beyond, which is the U.S. And there's a concern about how the U.S. has sort of the moral high ground, both with energy policy, with Saudi Arabia, with Riyadh, as well as to help negotiate some of the very difficult situations right now in the region, given the fact that the U.S. is kind of eating their lunch a little?
So I'll tell you, I don't subscribe to the is OPEC Plus relevant or not, because some years I'm told the United States is not relevant and OPEC controls the world, and some days I'm told OPEC has lost their relevance. Let's just say that they produce an enormous amount of oil, and they have, because of their collusion with each other, they have some impact on prices. But that's not what's important. What's important is where I started, and that is that our ultimate policy is I have to have enough oil on the market as long as I have the demand there and to make sure that the economy works. So my relationship with countries like Saudi Arabia or UAE or other producers around the world is to say, yes, you are producing oil, that's your revenue stream, but let's work together to invest on the other side, to invest in your disruption. And that's what we've told the Crown Prince of Saudi Arabia, and we are working together on investing in, there's more investment in renewable energy in Saudi Arabia and UAE than there is in many other countries around the world. That's where we want the cooperation of the future with oil producers, is how do we move to the next level? One, reducing emissions while they're still producing, and two, to use the revenues that they're getting from oil and gas and invest it into EVs and renewable energy and critical minerals and supply chains, and to make sure that the energy future that we have, the clean energy future, doesn't have the same geopolitical risks that we've had for 100 years on the oil and gas side. And that is a huge risk right now that is not, people talk too much about the oil and gas side and not how much work we have to do and are doing to reduce the geopolitical risk that the United States will face and others in the clean energy future. And that's the real work that we're doing now.
Do you think we're trying to move too fast?
No, on the contrary. I think we have to continue to work as fast as possible. It doesn't mean that everything goes up all the time, right? So you can have certain things that will sell very fast. You have to take a little bit of a break, look at where the plateau that you've reached.
Well, let's talk about the bumps in the road right now.
Sure.
So Hertz, bit of a reality check for them. They've got to dump 20,000 EVs. Cost of carry is just through the roof. Can't afford them. Demand's not there. Ford F-150. It's not exactly exploding right now. They've been cutting production. You see example after example in America right now that it just feels like maybe we're trying to move too quickly.
Well, I think what you saw with the legislation that the president pushed through was to address exactly this problem. So we've grown in the new car sales of electric vehicles dramatically over the last couple of years, sometimes doubling in 1 year. That's a lot. So we've accelerated beyond expectations. That comes with the fact that you have to accelerate the infrastructure that needs to be there to support it. How many charging stations? People in multiple polls will say one of the things that worries them about EVs is the charging stations, will they have enough? And that's what the IRA is supposed to do, is to be able to invest and making sure that we have the deployment of the charging stations
Secretary
there.
Kerry says the range anxiety is a misinformation campaign. What's that about?
You have to ask him what he meant, but I think that people want to be able to have an affordable car that they can manage their day-to-day lives with. And most people don't go 200 miles in a 24-hour period. They drive a lot less, they go to work, they take their kids to school, they go shopping, they come home, they maybe go out downtown.
Yeah.
So the needing 400 miles on one charge, I think is not what's holding people back. They don't expect that on anything else. But we do have to have the comfort and the convenience that goes with knowing the peace of mind, that knowing that if I go on the road, I'll know what to do with my car if I run into a longer trip than expected. And I think those are the kinds of issues that we need to work on. So instead of going into these, extremes of EVs don't work or EVs are working, we have to look at what's stopping people from buying them. How do we address that issue? And that's what President Biden has been doing this whole time, trying to avoid the hyperbole and going into what do we have? What are the solutions? If we want to be the leader in the auto sector for the 21st century, we have to invest now. We have to make the investments so that we are the sector lead. People are coming for us. They want to compete in this sector, and they're investing enormous amounts of money. People always say that what we're doing is not fair because it's not free market. I tell them the energy sector, there is no free market. Most of the energy sector is controlled by governments around the world. And we need to put in American dollars, not to replace the private sector, but to incentivize the direction of travel so that we can accelerate this energy transition. Because if we don't, we will fall behind. Not only will we sin to our children and grandchildren on climate change, but we will actually do a disservice to American economic security. The private sector is not going to make these investments because if they're not 20% IRRs or 18%. So what we need to do is to have that incentive, both on the tax side, credits, other incentives, and the actual spending, so that the private sector then comes in and makes those investments. We've seen it work in the CHIPS Act, where that's not only an economic security, Jonathan, it's a national security concern if we're not making the chips for the future that we are trying to create. We lead the world in the technology. We have to have the infrastructure, and we have to have the inputs into that.
We could talk about this for a long time. It's good to see you.
It's good to see you.
Thank you, sir. Appreciate it, buddy. Amos Hochstein there, representing the White House. Paul Taubman, CEO of PJT Partners. Paul, thanks for being with us for the last 60 minutes. Appreciate it, sir. Coming up in the next hour, an ECB rate decision. Up next.
We're just at the very beginning of heading back towards normal and what normal would be.
My feeling is inflation still comes down. I think we're in the camp that says that we're in a declining trend in inflation.
It is possible that inflation just comes down and we don't go into a recession. But is that the likely case? No, it never has been likely.
Things could change and move around pretty quickly.
We're not out of the woods yet in having a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The anticipation is off the charts. The ECB decision just around the corner. From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market unchanged on the S&P 500. We've been spoiled. 5 days of gains on the S&P, 4 new all-time highs. In the pre-market, Tesla negative after a dreadful outlook. We're down by about 8 or 9% in the pre-market. That's one to watch. The ECB, Bramo, 14 minutes away.
We're on basically pins and needles. Look, they're going to hold, right? The 8:15 release a.m. Eastern isn't necessarily going to be what gets a lot of people's attention. It's going to be 8:45. Christine Lagarde takes the helm and then has to maybe walk back the fact that the market is expecting, pricing in 64% chance of an April rate cut. Can she do it? Will she talk about Trump? That's where the fireworks are going to be.
We're talking about the magic of a soft landing may be developing here in the United States. Growth is still good. Inflation is slowing down. Can we say the same thing about Europe? Because the data over there has been dreadful.
No, we can't. And I think that that's what people are looking at. They're saying, look at the data, because honestly, at this point, the central bankers, they can say what they want, but they're kind of caught in what Joe Davis was talking about as the Heisenberg theory, which is that essentially the more they lean into some sort of soft landing that they've won, the more the market moves away from them and they get further away from the goal.
The German finance minister spoke about this at Davos. He said, stop calling us the sick man of Europe. We're tired man. We need a good night's sleep and a good cup of coffee. This is what Christian Leitner was saying. And he's talking about structural reforms. And I think the big takeaway we had from Davos, even before even going into Davos, when Christine Lagarde spoke to France too, was the fact that Europe has a reckoning of looking within itself to shore up their own growth models and not be so concerned about the U.S. election, who's going to take over the White House.
The euro totally unchanged, 108.88. That decision just around the corner. 30 minutes after that, you have the news conference with Christine Lagarde. Coming up on the programme this hour, Amanda Liner of BlackRock on the ECB rate decision. Deutsche Bank's Matt Lazzetti reacting to US GDP and inflation data. Jobless claims just around the corner. Then the lady herself, President Lagarde of the ECB. That news conference at about 8:45 Eastern Time. We begin with our top story. Counting down to that ECB rate decision, Amanda Lynham, head of macro credit research at BlackRock, writing this. President Lagarde has cited upcoming data on first quarter wage negotiations as key. As we have outlined previously, the reason for eventual rate cuts is much more important than the timing. Proactive cuts to calibrate real interest rates are a more supportive outcome for risk assets. Amanda Lynham joins us now for more. Good morning, Amanda.
Good morning. Thank you for having me.
I'm so with you, so thanks for being with us. Not all rate cuts are created equally. What are the kind of rate cuts that you're looking for?
So for the Fed, I think we're expecting, and this is a supportive outcome for risk assets, rate cuts to calibrate a real inflation adjustment. Basically, as inflation declines, we would want to make sure that the real rate doesn't become even more restrictive. I think it's a much different backdrop in the euro area. And I think there, the President Lagarde's speech from Davos actually showed us that they're still being patient. They're balancing the risks to growth alongside the risks that they want to avoid a situation where they're cutting prematurely, inflation reaccelerates, maybe because of the wage data, and they need to hike again. But I do think there are different catalysts behind each central bank in terms of why they're cutting. The market's very focused on the timing, but it's really the reason that we're focused on.
I don't want to be too snarky about this meeting, because the reason why I say that it's not going to be necessarily that exciting is simply because I don't really get the sense that the central bankers over in Europe have the front seat here. I feel like it's the economic data that people are watching and they're calibrating around that, and they're not buying what some of these central bankers are selling. How much is that the case, and how much are you kind of leaning against the enthusiasm that you've seen in the periphery and other areas in Europe?
Well, I think actually it's a great point you make. The folks that have the front seat are the corporates in many instances. And we saw that during the supply chain disruptions during the pandemic, where, for example, the semiconductor shortage was expected to ease quickly. But if you actually listen to what those companies were saying in terms of those who were using semiconductors in their products, it was a much different story. So we are pushing back against the market's pricing, and this is true in both the U.S. and in Europe, for swift, immediate rate cuts starting in the first quarter. Our base case in the U.S. is for a rate cut in the second half of 2024. We've acknowledged that the risk could be earlier. In Europe, I think the wage data will be important, so I think President Lagarde will wait for that in terms of the April and May color to see, is inflation sustainably heading towards their medium-term target. I think actually what the more important factor that we're watching now is how patient will these central banks be to get inflation to target. So if we are at 2.5%, how forceful will they be to get it back to 2% medium term? That is, I think, where the balance of risks might be shifting, is that we know that rate hikes are unlikely. We know that rate cuts will start eventually. But how patient will they be once they start to get inflation back to target?
How different is the U.S. and Europe in that regard?
Much different in the sense that the growth inflation mix in Europe is much more challenging. So a much more challenging, specifically on the manufacturing side, environment in Europe. Whereas in the U.S., you have a much more supportive growth backdrop. And thanks to elevated job vacancies, the unemployment rate has remained stable in the U.S. because job openings are being removed from the market. People aren't necessarily losing their jobs to a large degree. So the labor market has been rebalancing in the U.S. thanks to that unique, I would say, post-pandemic situation. Not so much in the euro area. It's a much different growth inflation mix.
Well, financing in Europe is different to financing in America too. You know this well. We talked about it with Standard Chartered earlier this morning. Bank lending channel is vital for Europe. In markets here in America, it feels like financial conditions are looser. They're easing. Do you see the same thing in Europe? How different are those two things?
So two things I would note. One is the bank lending survey did show a moderation of the tightening. So we're seeing still tight credit conditions, but it's not getting worse. In the European corporate markets, actually, we're seeing signaling similar to what we're seeing in the U.S., meaning very strong new issue activity, lots of oversubscription on books. Deals are trading well on the break. New issue concessions are minimal. I would say the tone is probably more strong in the U.S., but it's good enough in Europe that corporates have been able to do the refinancing activity that they need. Yes, the bank lending conditions are tight, but they're not getting worse, and I think that's really important. But even beyond that, the market functioning on the corporate side is actually quite solid and strong, actually.
Boom in credit supply to start January in the United States. Can you walk us through the quality of the kind of stuff that's come to market and tell us, is this catch up for last year or pull forward for this year? Which one is it?
Right. So in our first quarter outlook, which seems like a lifetime ago that we wrote in November, we had wrote that one of the key risks was that most of the active supply activity in 2023 was by high quality, high yield issuers. We didn't have a lot of issuance from triple Cs. That actually has changed in recent weeks, and we've seen multiple triple C rated firms successfully tap the capital markets. markets, which I think is a really positive sign in terms of market appetite to refinance these companies. Those outcomes will remain idiosyncratic for sure. That's a highly idiosyncratic group. But I do think that's a really positive signal. We're seeing similar and borrower-friendly market conditions in the leveraged loan market, amend and extend activity, loan repricing activity. And I think on net, it actually is supportive for credit quality and allowing these firms to refinance and kind of get ahead of the maturity walls that they need to address.
How much is this a U.S. story and how much is this sort of a global story? We've heard a number of people say they're going into emerging markets, even China.
Yeah.
And how much is that something you can play into versus the U.S. is strong, everyone else is still kind of struggling?
So I do think that, as I mentioned, the growth inflation mix in the U.S. is in a better position, I believe. But valuations in Europe on the credit market are actually more attractive than the U.S. market, not to a large degree, but you are getting compensated for that risk. I think one of the really interesting things from my perspective is this kind of significant demand for corporate credit to start the year. We're asking, where is this coming from, right? Is this the money market activity that everyone's talking about? Actually, what we're seeing is it's from a wide variety of investor types, insurance, pensions, asset managers. Some folks are rotating out of short-term cash products into corporate credit. Some are rotating out of other asset classes. Some are kind of bringing their allocations back to neutral where they may have been underweight. So I do think that there's a broad-based kind of appetite to lock in all-in yields, maybe taking a view that we're seeing peak rates. Not peak policy rates, I should say, not at the long end, right?
Super busy start to 2024. Amanda Lynham at BlackRock is going to be sticking with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger.
Alaska Air is expecting slower growth in 2024 after a challenging start to the year. The airline says the financial hit will be $150 million from the early January mid-air accident that grounded some Boeing aircraft. Alaska's fourth quarter earnings beat the street's estimate. Tesla shares, meanwhile, are extending their slump. Elon Musk has failed to convince investors to overlook last quarter's slower sales. The EV maker just narrowly missed estimates and warned of a notably lower volume growth compared to the last year. Tesla has been cutting prices in the U.S. and China to boost sales, which ate into profits. And Porsche has unveiled a battery electric version of its best-selling Macan SUV in Singapore. Bloomberg's Ed Ludlow spoke to Porsche North America new CEO Timo Reich.
We are pretty sure that with the launch of the Macan Electric, we will pretty much not be able to cope with the demand, and definitely in the first year. I think there's definitely a lot of demand. A lot of people are waiting for a product like this. And this comes at a stage where the Macan, as we have it in the market right now, with the combustion engine car, has its most successful year in its history as of last year.
That's your Bloomberg Brief. John?
Hey, Danny, thank you. Appreciate it. Let's pick up on that story just for a moment. Bramo, national champions. This is going to become a big, big deal in the next 12 months. If these car companies can't compete with the low-cost providers, low-price automakers out of China, this conversation that President Donald Trump's having about higher tariffs, if he gets another term, comes back into power, it's going to become an even bigger conversation. And I think the pressure won't just be on him. I think the pressure will be on Biden as well. If GM, Ford, Stellantis cannot compete with what's coming out of China, how do you think this is going to work out after the deal they signed with UAW in the last 12 months?
It's going to be incredibly challenging. Do they just sort of get out of the EV business altogether? Or on the flip side, do you end up with the political pressure to lean into the green story and actually embrace some of the cheap vehicles from China to then wipe out an entire industry in the United States?
You put up the barriers, I imagine, is what's going to happen, particularly in Europe. You're going to hear more and more calls to put up the walls. Up next on this programme, we'll talk about Europe. The ECB rate decision is coming up next. Live from New York City this morning. Good morning. Equities just about unchanged on the S&P. The euro a little stronger, 108.93. The ECB decision 25 seconds away. Going into it, equities doing okay on the S&P, just about unchanged. On the Nasdaq, positive by 0.1%. In the bond market, stateside, 2-year, 10-year, 30-year. Yields on a 10-year lower by 2 basis points, 4.1587. And to finish on foreign exchange, the euro against the dollar shaping up as follows. The euro at about 109, at 108.93. The ECB decision just seconds away. You'll get a couple of things here. You'll get the decision, a statement, a bunch of headlines. 30 minutes later, you'll hear from Christine Lagarde. We are unchanged at 4.50 on the main refinancing rate. The marginal lending facility, 4.75, unchanged as well. The depot rate, 4%, unchanged as anticipated. Bramo, determined to ensure inflation returns to 2% in a timely manner. No change to a whole lot from the ECB.
A stunning decision to do nothing, which is largely as expected. Rate level to make a substantial contribution to reaching 2%, basically keeping all of the language that you saw sufficiently restrictive. Throw that in there for good measure. They're going to stay there as long as they have to. Data dependency, we get that thrown in. So we get all the key hallmark words that are coming out. The declining trend in underlying inflation has continued. So maybe, John, we're getting just a touch of that dovishness that the markets can cling on to and fully price in.
For those of you that are really keen, I'll share the first couple of paragraphs with you from the ECB statement. The Governing Council today decided to keep the 3 key ECB interest rates unchanged. The incoming information has broadly confirmed its previous assessment of the medium-term inflation outlook. Aside from an energy-related upward base effect on headline inflation, the declining trend in underlying inflation has continued, and the past interest rate increases keep being transmitted forcefully into financing conditions. They go on to say tight financing conditions are dampening demand, and this is helping to push down inflation. The Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. Based on its current assessment, the Governing Council considers that the key ECB interest rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. The Governing Council's future decisions will ensure that its policy rates will be set at sufficiently restrictive levels for as long as necessary. Maria Tadeo in Frankfurt has read the rest of that particular statement from the ECB. We can catch up with her now. Maria, what's your take on all of this?
Look, Jonathan, as you say, it's unchanged. Of course, we're expecting that. This is now the 3rd time the European Central Bank has kept rates on hold. They really want to milk this idea of higher for longer for as long as they possibly can. That's the idea going into this meeting. It is interesting, however, when you look at the statement, and yes, I agree, a lot of this we've heard already, similar language to previous meetings, but they do say now that the transmission is working and it's forcefully being transmitted into the economy. They also say and concede something that we know by looking at the data at this point, that some of the underlying inflation dynamics do point to declining inflation. Having said that, if this was a statement in which you were hoping for any clues about the future path for rates, obviously you got none of that. I think the focus now is fully now on the press conference. Do we get a Christine Lagarde that repeats what she told Francine? This is a summer situation when it comes to a potential cut. And do we get that kind of repeated pushback that this is not a Q1 situation and markets should wait, just like the European Central Bank wants to do, to get a lot of data all the way to potentially even June?
Well, Maria, I'd love you to weigh in on the financial conditions part, because that really they did highlight forcefully transmitting policy. Here in the U.S., financial conditions have eased to some of their easiest that we've seen in about 2 years on the heels of some comments from Jay Powell. How much is this of concern to ECB officials who you speak to, that the market's getting ahead of the ECB will make it that much more difficult for the ECB to cut rates on the time frame that they might want to?
Yeah, and look, the fact that they get this in the statement also reflects, remember, we had that London survey 2 days ago. So they basically say what the survey showed, which is, again, tighter financing conditions. But I think beyond that, of course, for them, the press conference will be successful. This is a bottom line if they manage to align their language with the market pricing. You did hear from the head of the ECB, and not just, but really a huge number of members of the Governing Council in force right before the quiet period, almost telling the market, the more you want to force us into a cut, the more we're going to delay it. The more you pressure us, the more we're going to resist it. We're not in a rush. So obviously you see this dynamic between the two of them. I think they will say it was successful. It was a successful press conference if they managed to narrow the gap. For the time being, the language, again, it'll be interesting to see what she says, is that this is a central bank that is not in a rush and does not want to be rushed. And yes, they do worry about a policy mistake in terms of if they go too fast, that would undo all the work that they've done over the past 2 years, including all of the social and political ramifications that it carried when it comes to inflation. And just to let you know, in Germany today, there is a strike over pay, over wage. That's something that obviously they will factor too. So to me, it's that, the wage, and potentially the tensions in the Red Sea. Remember, that's something they said they would monitor in the months to come.
Much bigger impact on the Europeans than, say, here things stateside. Maria, I'm with you. Wage negotiations, Amanda Lynham talked about that as well. That means we've got to wait. Philip Lane of the ECB talked about the same thing, the chief economist. It's going to be the middle of the year where you really get your hands around that data and can work out what you need to do. Forget all of that. Maria, get into the news conference. I want to hear about the politics. We've heard from Lagarde 2-3 times over the last week, weighing in on politics here in America. Are you expecting the same thing in this news conference?
Well, look, you know very well there was a survey that leaked, internal survey from the European Central Bank. I think the zeitgeist in this Euro Tower today is who leaked it and why. And some of the criticism reflected there is that perhaps this is a central banker that at times talks too much and weighs into topics that are not related to monetary policy. This is a central banker, as you said, that has weighed into the politics, perhaps a return of Trump. She even said the best attack would be a defense of the European economy. And of course, it's a very different type of central banker. Mario Draghi never spoke. He never weighed into the politics. He only concentrated in the monetary policy. But again, this is her profile. This is what she feels is her strength. She's never been shy. She talks. Maybe some would say too much, but she'd say, when you elected Christine Lagarde, you knew where you were getting. This is who she is. Perhaps not an economist, but good on the politics and good at consensus building. Nonetheless, inside the European Central Bank, for some, maybe too talkative lately.
Maria, thank you. Maria Tadeo of Bloomberg on the latest out of Frankfurt, Germany. That news conference, 24 minutes away. Was that Maria being diplomatic at the end there, Bramo?
Yeah, that was why she paused. Normally there isn't that sort of pause.
There was a pause before saying it. Yeah.
She did a good job.
In the FX market, the euro almost totally unchanged, 108.89. BlackRock's Amanda Lynham with us around the table. Amanda, you said it. We've got to wait, haven't we? We've just got to wait.
I think so. Three things kind of stand out to me. One is consistent with the Fed's positioning. The ECB just doesn't want to cut prematurely and then be in a position where they need to restart a rate hiking cycle. And I think today's decision and lack of activity, so to speak, confirms that. I think the two things that I would be watching for the press conference is, one, is there a catalyst in terms of growth deterioration that will cause them to consider cutting sooner rather than later? And then second is kind of how long does as long as necessary mean? How long does sufficiently restrictive for a period of time, and she was referenced, President Lagarde has the medium term often. How patient will they be in getting inflation down to the 2% target? They've reiterated that over and over, but just how forceful will they be if that progress is slow? That's also a question that we have for the Fed, frankly.
So how do you really judge financial conditions? Because this has sort of been the wild card, and we heard Jay Powell basically not address it at all in the December press conference. Is it becoming more problematic, certainly for the Fed, that things have gotten as accommodative as they have? And is the ECB maybe too complacent about how tight things are?
Sure. So financial conditions are a transmission of monetary policy. And so if they are easing, it just makes that more diluted. For us, we're really focused on capital markets functioning, market functioning. Do corporates have access? Are the low quality borrowers in the high yield market able to refinance their debt? That's true in the public markets and in the private markets as well. That's really what we're focusing on, to the extent that inflation or that financial conditions are so easy that they spur inflation and I would say a significant rally in risk assets. That can impede progress. But I do think financial conditions are important for the transmission of monetary policy. If it's as simple as we like where financial conditions are and we just want to keep them there for a little while longer so that we can be comfortable that we can cut and not have to restart a hiking cycle, I think that's a bit of a different story. Perhaps the hard work has been done. It was November of 2022 that we had our last 75 basis point rate hike from both the Fed and the ECB. So you would imagine that would have transmitted by now, but we'll see.
What do you make of this phrase, passive tightening? I'm going to use my hands. So
yes.
You've got the nominal rate up here, then you've got the rate of inflation, it starts to come down, and then the real rate increases.
Right.
so-called passive tightening. How do you manage around that? How do you communicate around that you want to do? And I'm going to read this quote directly from the ECB. Future decisions will ensure that its policy rates will be set at sufficiently restrictive levels for as long as necessary. You can cut and stay sufficiently restrictive, can't you?
Right. Well, you can, and I think that's what the Fed has also said. I think the issue, or maybe the complication with passive tightening, is it requires an assumption on the neutral rate, and we don't always know what that is in real time, and central bankers have said as much. So yes, I think if we're seeing clear, sustained progress on lower inflation, it would make sense that you would want to bring the nominal rate down in tandem to keep the restrictive rate somewhat in a range. But I think there's a lot left up to uncertainty. This is just an unprecedented economy, and we have to manage a bunch of different factors, geopolitics, et cetera.
I've got to get a market call from you, just quickly. Yeah. What do you like right now?
We actually like high yield. I would say that it's been a game changer to me that the lower quality of the high yield market has been able to successfully refinance. It removes a negative tail risk that we were really focused on. And I think if we are comfortable that there's somewhat of a soft landing and capital markets remain open, I actually like moving down in credit quality. That doesn't mean chase triple Cs, but I do actually like the high yield spectrum.
Appreciate the clarification at the end there. Amanda, it's good to see you, as always. Amanda Liner of BlackRock, the second guest this week who likes some credit risk here. Bramo, Priya Misra, earlier this week.
And basically this idea that lower rated companies can borrow is a game changer, and we heard that again and again.
Up next on the program, tons of economic data from New York City. This is Bloomberg. Lisa wants to get new plants for the studio. What did you want? A money tree?
Yeah, they're really nice.
Okay.
I like that.
All right, you purchased that. Equity futures on the S&P 500.
Just wait.
Totally unchanged. We look like this. We're going absolutely nowhere. We're up by about 0.1% on the S&P 500. That's the equity market story. Let's talk about bonds. Yields lower by 2 basis points, 415.87. On a 10-year, on a 2-year, we're down about a basis point to 436.95. Heard from the ECB moments ago. No real change there. On a euro, 108.78. Got to move now off the back of some economic data in America. Let's get that data with Mike McKee. Hey, Mike.
Hey, John. Well, we got to look at GDP first because that's what everybody has been watching, and it's up by 3.3%, a significantly higher number than anticipated. The consensus forecast was for 2%, and so the number for the annual rate is going to be very high. I'll have to check that in just a second. Personal consumption comes in at 2.8%. That's a little higher than anticipated, lower than in the third quarter, but still fairly strong, and we'd seen that number previewed in the retail sales report that we got a couple of days ago. The price index, 1.5%. On a quarterly basis, the Fed has done its job, but the number that really counts is going to come tomorrow when we get the December number. Core PCE, 2% on a quarterly basis, quarter over quarter. So definitely a drop in inflation in the fourth quarter. Other numbers that really matter, jobless claims popped back up. They were 187 in the initial print last time, 189 revised, but now they're 214. So the number that we got last week was probably seasonally affected, and that's what we said at the time, and it wasn't worth paying attention to. But 214 is still very low. Continuing claims, 1,833,000. That is up from the 1,806 that we got the prior week. Remember, those are delayed a week behind. And then finally, durable goods orders flat on the month. They were expected to be up 1.5%. Remember, they were up 5.4% in the month of November. That's been revised to 5.5. But take out transportation, and it was up just 0.5% last month, 0.6 this month. So a lot of that is going to be Boeing numbers, and we can break that out for you in just a little bit. The final most important number for economists and a lot of people on Wall Street, a very strong capital goods orders number in comparison to what was forecast. 0.3% gain, but that's down from a 1% gain in November. So at the end of the month of December, at the end of the fourth quarter, business is still spending money. But one of the questions about the GDP, and I'll look for this while John catches you up. I'm sure, John, that the markets have probably moved on this since they were dead.
We've got
before.
a small move, Mike.
But let's see what business spending was in the fourth quarter.
I would say good news is good news. Just a little bit of good news. We're up by 0.25% on the S&P 500. Equities look like this, up by a third on the Nasdaq. There's your move on the Russell, though. The small caps up by more than 1%. In the bond market, yields were lower, then they were higher when the data came out. Now they're lower again by 3 basis points on a 10-year, 4.1414 on a 2-year, down about 2 basis points, 4.3510. Initially, when the data dropped, it was yields up, dollar stronger. We've reversed that as well. You can take a look at the euro against the dollar. You can see it on the chart. In the FX market, 108.95. Bramo, I think we can call that 109 going into the ECB.
This is messy data. This is immaculate disinflation. This is the narrow path that we were hearing about from Andrew Hollenhorst, that it looks right now like this golden pathway where you've got disinflation at the same time as much stronger than expected growth. The one kind of hang up here is initial jobless claims ticking up and continuing claims also ticking up just a touch around the margins. I just wonder how long this can continue. And Mike, I'd love you to weigh in. Does it seem like this is a moment in time, or is this a trajectory into the immaculate disinflation that this market is leveraged off of?
Kind of a combination of both. Our guest who's joining us, Matt Lizzetti, and I were just talking in the green room about this is a moment in time that we're seeing what we anticipated seeing and what the Fed was hoping to see, which is not immaculate disinflation, but inflation coming down without a major impact on the overall economy, because that never happens. Usually they tighten and the economy slows significantly. It has slowed. But it is not dropping off a cliff as people anticipated. But here's something really interesting. I was looking at the business spending number. It's 1.9%, which is not all that great. It was 1.4% in the third quarter. So this is largely, at this point, I haven't completely broken it down, but the consumer played a big role in this. But here's the non-inflation adjusted number. Nominal GDP, 4.8%. It was 8.3% in the third quarter. That is not only a reflection of the fact that the economy slowed some, but there you get the inflation numbers that came down so significantly are taking away from nominal GDP. And that really stands out as something that has changed in the economy if this continues.
Mike, thanks for the breakdown. Appreciate it. Matt Lizzetti with us around the table, Chief Economist of Deutsche Bank, Chief US Economist. Matt, good morning to you.
Good morning.
That's a lot of data. Where do you want to begin? Real-time reaction. What are you focused on?
I think the number one thing for the market is inflation. You know, for the Fed, they're focused on inflation. Getting 2% was expected, in line. Tomorrow we expect to get those details. We expect a 15 basis point print month on month for core PCE year over year to come down to 2.9%. So for the market, still this disinflationary trend, I think, is the number one story. When you look within the details, and we'll have to kind of comb through all the details, consumer spending was close to our expectations, but GDP was a lot stronger. And as I look at the inventories data, it does look like inventories probably added a decent amount to that print. So we'll have to see how much of that was, an inventory story. But I think to Mike's point, if you go back to when the Fed started raising rates, if Chair Powell would have been told that GDP growth would be close to 3% in 2023, core PC inflation would be below 3%, and the unemployment rate would be below 4%. It's basically the best outcome you could have hoped for at that point in time.
So do you buy it? Do you buy that this can last? Or do you think that this is a moment in time where either things get overheated with the growth continuing to come in better than expected, or things start to weaken with jobless claims picking up?
Yeah, we've been worried about the weakening story. We've been having this mild recession as part of our view, and it still is our baseline part of the view. But I do think that there's improving prospects for a soft landing here. Yes, you are seeing you have tight credit conditions, et cetera. But at the same time, I think that you do have some kind of virtuous dynamics. So mortgage rates have come down, mortgage purchase applications are picking up, financial conditions have eased. I think that does help to support forward-looking growth momentum. And at the moment, I am not as worried about that spilling over into upside inflation risks. Maybe those inflation risks come from, core goods or some of the supply chain disruptions that we're seeing. But we still expect shelter inflation to decelerate pretty materially over the next year. That's a big part of the disinflation that we anticipate. And so this Goldilocks scenario, perhaps, of growth being a bit stronger and more resilient, and inflation still coming down, that prospect, I think, has improved materially in my view.
Growth overall is higher than it was in 2022, yet the Fed was on this accelerated rate hike. To your point, and Lisa's point, is this moment of time. Is this as good as it gets for the timeline? Because I'm always looking at the timeline to the U.S. election.
Yeah, I think the unemployment rate might move a little bit higher from here. We do have it rising into the middle of the year. So we'll have to see how that plays out. If layoffs pick up, that's obviously a material negative. But at the same time, there are those, I think, improved dynamics that we have in play. Key for the market will be, what does it mean for Fed rate cuts? When do they begin to cut and how much do they cut? This data, I think, probably does not support the notion that the Fed cuts as early as March. But inflation is coming down quick enough to the idea that they should be cutting rates by the middle of the year. And I think that'll help to add to, I think, rates coming down, helping to ease financial conditions and therefore supporting growth prospects.
Can you elaborate on that? Because right now, two-year yields are lower on the day after this. Why do you think that this data precludes the Fed from cutting rates in March if you're continuing to see disinflation, which is arguably what they're supposedly targeting?
Yeah, to be clear, this does not preclude the Fed from cutting in March. I think most importantly, it's the inflation data. Second order, third order, what's happening on the growth side. So what we get on the inflation data over the next 2 months is really important. What we get for the CPI revisions. I expect a little bit of an uptick in the core PCE data over the next several months. If you get that plus some upward revisions, I think it creates some uncertainty about how much disinflation we're seeing. I think to be clear, there is this very substantial disinflationary process in place. It's just a question of whether or not you get an uptick over the next several months that makes the Fed a little bit more cautious.
I mentioned a phrase that you introduced in your research more recently, passive tightening, a little bit earlier on the programme. I wanted to talk to you about it. You've been focused on it. Is that something the Fed starts to talk about a little bit more in the news conference next week?
I think they have to. Chair Powell indicated that they started that discussion about rate cuts at the December meeting. I think very clearly that discussion will pick up at the January meeting where officials will more clearly outline how they're thinking about rate cuts over the next year. And for most officials, their story is soft landing, inflation is coming down very quickly. And if they don't cut rates, that the real Fed funds rate rises too much, and therefore they risk putting the soft landing at jeopardy and risk over tightening. That'll be the story we get from Chair Powell.
Can they entertain that without engineering a big easing of financial conditions? Can they entertain that conversation, do you think?
Look, the market is pricing 135 basis points of rate cuts already, so this is embedded in market pricing. If anything, I think Governor Waller was indicating that the December dot plot still is a good guide at 75 basis points of cuts. So I think they can entertain that and still keep financial conditions in check because the market's pricing so much.
Matt, appreciate the update. Good to see you.
Thanks very much.
Matt Lazzetti of Deutsche Bank. Equities right now on the S&P 500 higher by a third of 1%. Let's get you the morning brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. The FAA has put a halt to expansion plans for the Boeing 737 MAX. It's a blow to the company's cash cow jetliners. The FAA had just announced a path for the grounded MAX 9's return to service. After following a new procedure for inspections, United and Alaska Airlines could start using MAX 9s again as soon as this weekend. Hopes for an IPO from fast fashion maker Shein are starting to dim. Bloomberg reports investors are trying to sell shares in the private market at a 30% discount. Gabriel Caillot, General Atlantic co-president, told me earlier that the company still has a path to public markets.
Shein's a fantastically performing business, so it continues to grow extremely fast. It's globalizing extremely fast. We think it'll be a very successful offering.
General Atlantic is a stakeholder in Shein. Shares were reportedly offered last year with valuations ranging from $45 to $55 billion. Tesla CEO Elon Musk has told investors he needs a bigger stake in the company. Musk owns about 13% of Tesla, but is asking for at least 25% for more control and to fend off activist investors. In his pitch, Musk proposed dual-class shares and warned if he doesn't get a large enough stake, he could take AI and robotic products elsewhere. Tesla is trading lower this morning after missing fourth quarter earnings and disappointing guidance. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. What did Dan Ives of Wedbush call that news conference? That earnings call?
Train wreck.
A train wreck?
No, then he upped it to a plane crash.
Plane crash?
Yeah, a little too close.
Preschool, something like that. No adults in the room. It's pretty brutal for a Tesla bull.
And frankly, he's got good company. A lot of people are really a little bit down on the fact that he basically said he wants to run a tech company, not a car company. They make cars.
Stock is down in the pre-market. Shall I whisper equities? Sound like the president.
And Joe Biden's sitting here now.
It's like a Joe Biden thing, right? Equity futures on the S&P 500 higher by a quarter of 1%. In the bond market, we look a little something like this, a 2-year, 10-year, 30-year, shaping up as follows. Your 10-year right now, yields lower by 4 basis points, 4.14 on a 2-year. We're down a single basis point at 4.36. And a quick snapshot of the euro for you going into the ECB, 108.92. 108.92 on the euro against the dollar. Up next, it's the ECB President, Christine Lagarde's news conference. That's just around the corner from New York City this morning. Good morning. This is Bloomberg. Live from New York City this morning. Good morning. Here's the price action going into the opening bell about 45 minutes away, moments away from hearing from the ECB President Christine Lagarde. Equity futures positive by 1/3 on the S&P 500. The Nasdaq 100 up by 0.4. The Russell bouncing up by about 1 full percentage point. The data in America, I have to say, Bramo, let's sit on it.
Yes.
Better than good. And Matt Lazzetti of Deutsche Bank is right. If you'd predicted 12 months ago where we'd end the year in 2023, that we'd have growth with something like a 3 handle, unemployment with a 3 handle, and Fed funds at 550 through 5%, a lot of people would have just laughed at us, wouldn't they?
Well, they did. They said that the soft landing was a pipe dream, that basically we were going to get some sort of recession. It was almost a certainty a year ago when we came here. And now we're looking at basically this Goldilocks scenario. Just the key question is, how long can inflation keep coming in like this? Is this something that year over year comps get more difficult with going forward? Or is this really what we're looking at, which is supply chains normalizing? I mean, again, to look at 1.5% GDP price index in a period growing at 3.3%, higher than pre-pandemic, is pretty notable.
So let's set the compare and contrast. We've set the scene for America, set the scene for this ECB President Christine Lagarde, who's just walked into the room to start a news conference. Europe can't say the same thing about growth. They cannot say the same thing about growth. So when we're talking about this soft landing in America, we're already talking about recessions taking place across the Eurozone. And not just in the weak spots, the traditional weak spots. We're talking about Germany. Germany having a difficult time.
We're also talking about the potential for additional supply chain disruptions with the Red Sea and a lot of those routes going more to Europe than anywhere else. They have a much more difficult situation. And yet, to me, one of the key questions is, how do they signal that when they're still facing with inflation that's bad inflation? It's not necessarily from growth. It's from some of these other kinds of inequalities that they're seeing in their economies. This is a bigger problem for the euro.
So let's take the shot. Let's show the room. The ECB President Christine Lagarde, just about to get introduced. You get these long introductory remarks of the European Central Bank just ahead of the news conference. It's not like the Federal Reserve. Chairman Powell walks in and just begins.
Yes.
This is different. You do it the European way. Long introduction for each of them, who they are and what they're going to say. Here's the problem right now. You've got a challenge for growth, challenge to get inflation down. We'll be talking about avoiding a recession in America. Arguably, they've had one in certain parts of Europe. Then you've got this political question. The ECB leader herself introduced into the conversation that I imagine is going to come up in this news conference.
And it's really sowing some strife within her party, within her organization. It is going to be curious to see what she has to say, especially with so many eyeballs on her today.
Here's the ECB President, Christine Lagarde.